if you look at the economic data, I mean, it just keeps coming in, showing a tight labor market. We keep getting these numbers, strong spending.
In essence, we're seeing the economy is genuinely slowing some, but it's not falling off the cliff.
I think the equity market is focused on earnings.
We are in this sort of lull, waiting for the labor market to catch a cold so that we can actually, yes, stop this acceleration in wages.
At the end of the day, the question going forward is, can the consumer continue to live beyond means?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is a jobs day in America. Much going on. You think we're slipping into a holiday weekend? No. Most interesting, at least until 8:31 in the morning. Jonathan Ferro off today. Lisa Abramowicz off today. Paul Sweeney off today. I just begged for someone to come in. We are thrilled that the host of The Real Yield has decided to join us at gunpoint. Katie Greifeld here on a Friday before Labor Day.
I was waiting by the phone. I was so pleased to get this call. And it's jobs day. Like you said, this is a pretty good summer Friday.
It's a big jobs day in the inflation report that we have coming up in September before the Fed meeting. And what's so important here is maybe we should not say jobs day, but say it's wage growth or lack thereof day. We really need to see what the wage dynamic is today.
Absolutely. You think jobs feed into wages, feed into prices, and obviously that's what the Fed is going to be focused on. And they're expecting some pretty good news today if you look at the economist forecast for that wage growth. So we'll see if that actually delivers.
Thunderscrap, our team started working in middle August to get guests to drag themselves into our offices today. And we've got a great lineup coming up. Really, really looking forward to some intense conversations here, framing up September, framing up into the end of the year, and of course, even the ECB meeting on September 14th. I'm going to get right to it because the guests right now, too important as well. Sarah House joins us, always with Wells Fargo, their great labor effort. Ellen Zentner will join us, somewhat optimistic at Morgan Stanley. Great to talk to Seth Carpenter yesterday, I believe it was, from the Booth School in Chicago, the former Federal Reserve governor. Randall Krosner scheduled to be with us. And on bond gyrations here, and I'll start the data check with Jeff Rosenberg of BlackRock with the real yield 1.87. Comes back from the disinflation tendency we've seen in the last 24 hours. Green on the screen, why not? What is it, 14 days up in a row? We'll give you some equity perspective here through the show. The end of August, now the beginning of September. The bears humbled and in retreat. Futures up 11, Dow futures up 105. That bull market VIX 13.49. Well, Greifeld's here. I've got to quote Bitcoin. Usually we don't do this. Farrah and I haven't quoted Bitcoin since Nixon was president. 26,000 on Bitcoin coming back. We'll talk to Katie about that throughout all of this morning as well. 2-year yield 4.86%. It's a churn to the bonds, maybe a little bit higher yield. And the whole tendency across equities, bonds, currencies, commodities is to give way from a disinflation, sort of middling range bound, is how I'll call it, into 2 hours and 30 minutes away, that jobs report. Of note, oil, I really want to point this out. It's grinding higher, but maybe it's just got a lift to it. 87.76 on Brent crude. I'm sorry, a 90 print there would be game-changing, and it's every day up 0.5%, every day up 1%. Even West Texas Intermediate, the American price, $84 a barrel. Katie, John Ferro looks at Euro 108.47, sort of as a dynamic here of what's going on in Europe versus what's going on here.
It's interesting at this point to see Europe and the U.S. facing really different problems here. I mean, you think about those two central banks, they've really been moving in lockstep over the past 3 years or so. But now it feels like we're getting to the point in the cycle where we could see some divergence potentially as soon as this month, since it is September 1st.
Before we get to Steve Whiting, China, it has really been something today. And in the last 24 hours, there I was looking at some point at the news, and another tweak by China, this having to do with currency reserves. What you need to know is there's not one big announcement from China, but lots of little drips. 1, 2, 3, 4 is a move to boost the currency, to give the renminbi some protection They got it with their announcement, 7.28 into 7.26 yuan, but certainly into this American holiday weekend, all eyes on the economic challenges of China. As I've mentioned, we're really humbled by the quality of the guests this morning. You'd think everybody would be out at their 8,000 square feet in the Hamptons. Steve Whiting is not. He joins us now, Chief Investment Strategist, Chief Economist, Citi Global Wealth, truly expert on linking in the job economy, the greater GDP numbers into the profits of America. Is America flat on their back? It seems to be the great miscall of the year, and that America was really going to do poorly, recession and all that. I know you don't believe in Atlanta GDP, but we've got a buoyant economy, right?
Well, the economy will grow a little bit more this year than it did last year in real terms. But if you're thinking about employment, if you go to the July employment report, the last one, 187,000 jobs. The one that we had, the July of 2022, was just below 600,000 jobs. So the fact is, input and output in the economy are growing at different pace, and they're going in different directions. We're likely to firm up a lot of cyclical businesses. Over the course of next year into 2025, I think employment is going to continue to slow. The Fed's going to get its way with the labor market. They are very set on having a higher unemployment rate. We just lost 2.6 million job openings over the last 12 months. Hey, we've been able to continue to grow overall employment. I don't think any collapse is coming. Right. But again, the business output and profits, which were down 6% in the year through 2Q, I think we can firm all of that up with steady headcount, and that's where we're headed.
I look at this, Steve Whiting, and what I want to do is sum in, and I rarely say this, but on this jobs day, I want to know what the Fed will look at 8:30. Within the reams of data, the two studies, what will matter for Jerome Powell and the Fed?
It's rarely a single indicator. But the fact is, if labor demand continues to grow faster than labor supply, then they're unhappy, and vice versa. At this point, when they take a look at an unemployment rate in the mid-threes, they want to see that the balance of labor demand it's the direction of travel. I mean, I think many will take a look and say, well, the economy can't produce 190,000 jobs every month. We don't have a working age population that will do that. But the fact that we've come down the slowing pace this much, and if it continues to move in this direction, they're going to be less concerned about whether or not monetary policy is tightened enough. In fact, and I think it will head in the other direction in the coming year.
Well, Stephen, when does a slowdown in the pace of headline job growth translate into a higher unemployment rate that the Fed wants to see? You mentioned that, of course, we've seen job openings really cool down from some of the big JOLTS numbers that we were getting. But when do we actually see what the Fed wants to achieve in that unemployment rate?
It's very difficult to know whether people on the sidelines will continue to search for jobs, whether labor force participation, very active labor force participation, will show up in the unemployment rate or not. I think that the balance is probably going to push the unemployment rate up at least modestly, and it'll be at a lot slower pace of headline employment gains. And the reality is you will not see wage pressures that look anything like where we've just been. And let's just remember that, the CPI was 9%. It's now 3.2%. That happened with a steady unemployment rate.
Right.
And so very little of this to begin with had anything to do with the labor market.
Bring the board up. For those of you on radio, our team has really put together a nice show today with some nice numbers. And Katie, the Steve Whiting math there is important. Hourly earnings growth 4.4%, and Mr. Whiting's working with a 3% statistic. So you've got real wage growth out there. Neil Dutta, the optimist at Renaissance, is saying, look, the fact is when you look at the dynamics, real wage growth is rising in America because of that disinflation.
And you could argue that you saw that in the personal spending numbers that we got this week. Consumers are still spending. And let's meditate on wage growth a little bit, because it is expected to cool again slightly this month, both on the annualized basis and the month over month. But what pace of wage growth is consistent with a 2% inflation target?
Well, this is a lovely question, because we have in the past never had wage growth at 2% to get 2% inflation. I mean, in the way the last couple of decades have worked out is goods price restraint, import prices, productivity growth in the goods sector produced a mild pace of deflation or steady prices, and services were higher. Then we started to hear during this really hawkish phase from Chairman Powell that, well, let's get wages consistent with 2% inflation. And many people thought, well, we have to do something about services prices to make sure that services prices grow no faster than 2%. Now we look at a China that has a 7.5% pace of export price decline in their currency. And we're saying, well, we might end up with a world in which we end up with a bit higher level of domestic services prices, and it's still consistent with 2% inflation, just like we've been in.
I want to go to chapter 23 of any economics book, Steve Whiting, where you are just the best, and that's a profit generation of American corporations wrapped around a nominal GDP that I believe is coming down.
Right.
A real GDP that's sort of a mystery. I mean, it can be this or that or the other thing. But is there just a belief within your work that profits will sustain and revenue growth will sustain?
I think it's going to be slow, but more positive than it's been. There are pieces of the economy. This is a lot like the opposite of that movie title. There's no collapse in everything all at once.
Yeah.
We have cycles everywhere, and we have pieces that are coming down and others that are continuing to grow and push up.
And retail's getting hammered right now.
Yeah, I think we are seeing something pretty good coming out of this. Like you mentioned before, with real wages going up, we are in the services sector where we had a depression a few years ago with COVID. We're going to continue to grow employment some. It's going to slow in its pace. But during this process, we've been able to start to pull down inventories in the United States without having a full-blown collapse. And that is working off the troubles of the industry. Now, it's not going to go away quickly. It's not going to be super fast in this way. But by 2025, we're going to have a world economy, I think, that you're going to see cyclical industries start to pull up trade, pull up production, all of these things that are restrained right now. We've had 10 months without a net gain in industrial production in the U.S. We have the same sorts of declines in exports that China's experiencing, but as an economy, it matters less to us.
I want to talk a little bit more about corporate profits. There's a really interesting piece in Barron's this week. They looked at virtually every sector in the S&P 500, and they found that net interest expense as a percentage of net profit, it's lower today than it was 20 years ago, which kind of blew my mind. When you look at corporate America right now, how sensitive is the stock market and corporate profits to interest rates?
So asset prices can still be sensitive to the competition of higher yields. I mean, we have to take a look every day at the relative value of bonds and stocks. That's one thing. In terms of, again, profitability and solvency, high yield companies, their outstanding debt stock was financed at 6%. And again, we're talking about sub-investment grade companies. We're talking, I think the numbers for 2024 is only 8% of high yield firms will have maturing bonds. Essentially, the stock of maturing bonds is really small in 2024 of companies that would have to refinance at much higher rates.
20 seconds. Where's the 10-year yield a year from now? Are you looking for, Ian Lingen was in from BMO Capital Markets with a stunning price up, yield down for sovereign debt. Do you agree?
I think that's right. I think that we will be sub 3.5% on 10-year yields a year from now.
Stephen Whiting, thank you so much. We start strong on Jobs Day with Mr. Whiting of Citi at Global Wealth. Futures up 13, Dow futures up a big 111. Make that 0.3%. We're quoting the Dow a lot today just for Ferro.
Okay.
He's on sabbatical. The VIX 13.48. Part of the drill here, folks, is to get one Catherine Greifeld, the star of The Real Yield, to come on. We had to talk BitDog. And the good news is there's actually a lot to talk about. How good a Labor Day is Mr. Gensler having?
You know, I think he's had a pretty tough week overall. He had a pretty crushing blow when it came to that appeals court. So hopefully he has a good Jobs Day because, again, it's been a rough week.
It's been a rough week for the head of the SEC, but then has it been a win for packaged product Wall Street? Are they there yet where they can say they've got to win with an ability to package Bitcoin, or do they not?
They can still slow walk this, the SEC. It's still going to be a process. We had some...
How long a time frame? What's the Greifeld timeline on this?
Well, the SEC has 45 days to appeal, so at least 45 days.
Okay. Catherine Greifeld at gunpoint. We do Bitcoin on Jobs Day. I'm enthused. Futures up 13, as I said before. What am I looking at? Let's look at the real yield for Katie Greifeld. The real yield here, 10-year yield, 1.87%. Steve Whiting never believed we'd get to a 187, maybe on our way to 2%. Stay with us on Jobs Day. This is Bloomberg.
I say to the Republicans all the time, take back your party. The Republican Party is a great party. You've done great things for our country. You're not a cult to a thug. Hopefully, as soon as we get through this, shall we say, cancerous situation that we're in, the malignancy of Trump, they will emerge in a strong way with the leadership that I know is there.
By way of Baltimore, the Congresswoman of California, no longer the Speaker. And, my 2 cents is she talks differently than when she was Speaker. It's a different Nancy Pelosi than what we've seen for the last number of years. The former Speaker of the House of Representatives. They're in conversation with Bloomberg. Katie Greifeld in for like 4 people today. She's like killing it with a multiple set here. The star of The Real Yield is in on Jobs Day as we get ready for this important set of data at 8:30 and all that's going on. And, is going to be a sleepwalk August? No. Sell in May and go away? No. Sleepwalk through August? No, we didn't do that in here on September 1st. We welcome you on equities, bonds, currencies, commodities to all that we do here at Surveillance. Florida, Georgia, the Carolinas, they pick up the pieces of a hurricane in America. There is a hurricane to the east of Bermuda called Franklin, but far more active and always more active on the far side of the world are typhoons, and it is tangible in the evening in Hong Kong. This is from Kowloon. This is a shot. Our executive producer Qantas has a suite thing going on at the Peninsula Hotel. This is a shot outside his hotel room. Over at Hong Kong Island, the Bloomberg headquarters is there as well, the convention center, and of course all of the memories that we have of Hong Kong, and of course the new Hong Kong, so Beijing influence. What they're influenced by this morning is the second highest typhoon alert. They are back 5 years in terms of gravity. The exchanges are shut down, and we'll be following that through the weekend here at Bloomberg Worldwide, and particularly with Yvonne Mann and all of our Hong Kong offices as well. We speak to the typhoon of political strategy. Gregory Vallier joins us right now, Chief U.S. Policy Strategist at AGF. Greg, I loved your elegiac note about August. Write the note for September right now. Where are we going to be October 1st?
Well, I'd say, Tom, good morning. I'd say there's going to be 3 big issues as this month proceeds, this new month of September. The first is the very real prospect we could have a government shutdown on October 1 because we can't get even a continuing resolution. Number 2, I think there'll be still a tremendous amount of speculation on how Ukraine did in the month of September. They're finally making an offensive. Things look a little bit better now than they have for the last few weeks. And then the other big story, I would argue, Tom, is the United Auto Workers, whose contract expires on the 14th of September. I think it's entirely possible on October 1, we'll be looking at a strike.
Well, let's start with the last on your list there, given that that's the most urgent in terms of timelines. What would you expect to happen between now and then? Would you expect that we can avert this strike, or does it starting to feel inevitable?
Well, we averted a strike with the Teamsters and the UPS, so it's possible it could be averted, but in the last 24 hours, there's been a lot of nasty talk. The union is saying the companies are not bargaining in good faith. So this will go right down to the wire. Even if there's a deal, Katie, the other big story here is how enormous the salary increases are going to be.
And of course, that's a timely point, given that we are awaiting those jobs figures at 8:30 a.m. today. And obviously, wage growth is going to be one of the things we look for first. When you think about the political aspect of the strikes, and really they go across industries, and it's been striking, if you will, to watch that this summer. How does the Biden administration handle this? Obviously, Joe Biden is seen as pro-union. How does he turn this into a talking point, a campaign point?
It's a difficult task for him, Katie. I think that you'll see more sour rhetoric back and forth. The union is not happy with Biden. Biden realizes that there's a lot on the line here. And I do think even a brief strike is going to put the president in a very difficult position.
Hey, Greg, I look at where we're heading here. We had a Republican debate. I assume we've got others on a Valier date calendar as well. And as we heard earlier, I mean, from Speaker Pelosi, the Democrat from Baltimore, her father was mayor of Baltimore years ago. She's begging for a return of the Republican Party to a normalcy of another time. Is that wishful thinking on the part of the gentle lady of San Francisco?
Yeah, I think, her father, Mayor D'Alessandro, wouldn't recognize either party right now. And I'd have to say that one of the amazing stories of this really remarkable summer is that with all of the indictments of Trump, all of the really serious charges, he's held up brilliantly in the Republican Party. He still leads in most every crucial state by at least 30 points. In some states, his lead is close to 40 points.
I look, Greg, at where we are, framing it up forward and all that. I just have to wonder what the response can be to the absolute original position we're in with former President Trump. How does Tim Scott respond? How does Washington respond? How do the big Republican donors respond to the predicament President Trump is in?
Well, that's a really good question, Tom. I think that increasingly the donors and the establishment in the Republican Party are looking at Glenn Youngkin, the governor of Virginia, fairly moderate, very wealthy, good campaigner, won a crucial victory in Virginia against Terry McAuliffe a couple of years ago. So I think that there still is room for one more candidate. But as of right now, it's going to be an uphill fight for any late entrant to really make a dent in this huge lead for Trump. Tom, there's a chance that Trump could be the nominee under indictment. There's a chance that Trump could be in jail and still could be president. It is not totally out of the question.
Greg Valier, thank you so much with AGF Investments. And I want to draw to your attention as you look for your reading into the autumn, the absolute world-class character of Bloomberg Opinion on legal issues in America. It's so advantaged to have Noah Feldman of Harvard University with us, and the leadership of Tim O'Brien, expert on the Trump finances way before the politics, going back decades and decades and decades. Look to Bloomberg Opinion to sort out so many of these contentious issues as we go through 2024. A little bit of time here, some technical difficulties there with Greg Valier, which gives us the advantage of talking to the star of the real yield. Ian Lingen of BMO stunned me yesterday by framing out a 10-year real yield from about 1.50%, dare I say up to 2.2% as well. And I asked him, does the economy fall flat on its back with 2.2%? What have you learned in your discussion of this on the real yield?
I believe he called it a screaming buy, right? The 10-year
10-year price up, yield down.
Heard around the world, at least from where I sit. That was fascinating. And even though you have seen the price action agree with Ian Lingen, it still feels like people are bracing. The investors that I talk to are bracing for higher yields from here. There's a lot of talk that maybe the fair value rate for the 10-year Treasury right now is closer to 4.5%. We got pretty close to that this month.
Yeah, but aren't these just opinions? Aren't these just like, I mean, I get it. We listen to all these people and that, and you're suggesting the consensus is for higher yields right now.
That's what, at least the consensus that I speak to.
Well, that's the, you're doing afternoon TV and a morning TV. They're all looking for lower yields. So
you've got the optimist. Is that optimistic at this point?
That's a really ambiguous question and an ambiguous outcome as well. And the basic idea here is it can cut either way. If you go price up, yield down, Ed Hyman is looking for disinflation over at Evercore ISI. And if you get price up, yield down, is that good or bad for the economy?
Well, it seems like Ian Lingen struck the optimistic tone that it's, a case to be made that the Fed has inflation under control. But you're also speaking to Cameron Dawson. I really prepared for this show, Tom. I loved what she said, that if the 10-year yield is going back to 3%, that's a screaming sell for equities. That's a recession.
Yeah. Would somebody get a memo to Greifeld? We don't prepare for the show. No. We just sort of show up and break open the tang and move forward. It is Jobs Day, and seriously, it's going to be something special treat. The only one of a team not taking off the day, Michael McKee, will be here to pick up the pieces with Sarah House senior economist, Wells Fargo. Michael McKee at 8:30. Good morning. It's Jobs Day. Bloomberg Surveillance. It is Jobs Day. We're thrilled you're with us here. Lisa Abramowicz and John Ferro off today. Katherine Greifeld has joined us here. Are you filming The Real Yield this afternoon?
I am. 1 p.m.
There we
Eastern.
go.
It's a big week.
It's a big week. And for your Labor Day consumption here, The Real Yield, you can look for that out on our digital project, also on Bloomberg TV, because the real yield really matters, and especially matters to the Federal Reserve meeting that we'll see here the third week of September as well. Again, a great lineup today. Ellen Zettner, Randy Krosner will be with us as well. Really looking forward to that. But right now, let's dive into under surveillance. We've got 3 under surveillances today, and the first one we're going to sit on, as they say, and we're going to do this with USDCNY. This is the Chinese renminbi, the yuan, and I asked Meredith to take it back longer to the historic moment where I met John Ferro.
Ooh.
I met John Ferro in the upper left corner, 2005-ish, when it was fixed and they gave way to an ever-strong Chinese boom and a strong renminbi, and we have started to give it back with a vengeance. We're out to 7.26 this morning, and there's a lot of talk about moving higher, a weaker Chinese yuan. And Katie, nobody I know is framing getting back to 2005 in the fixed level, but never say never. I mean, there's a lot of turmoil there.
There is. And I remember I actually started out covering currencies, and I was fascinated with the yuan.
Oh, is that Bitcoin's a currency? You're going to sell
what
me on that right now?
Yeah.
Gary Gensler's watching this morning, so step
Bitcoin
carefully.
in like 2017 didn't talk about it as much as we do now, but 7 was seen as a line in the sand.
Well said.
Yeah, and we've blown past that, obviously. We initially got above that in 2019, right when I left the beat. I had been waiting for it, and then we got past it. You look at the levels we're at today. I wish I could tell myself 5 years ago that we'd be here.
Yeah, a headline just out moments ago. In Shanghai, they eased the home buying mortgage rules. That's got to be one of those tweaks we mentioned, the water drip here of 5, 6, 7 things going on in Shanghai. Francine Lacroix will drive forward the conversation for us, her Italian coverage at Chernobyl today. Greifeld out looking at new Teslas this weekend. Tesla unveiling a revamp of its Model 3. It's bright red.
Yeah.
Just hours after the EV maker, they rolled out price cuts on S, on X, on there. What's the so what here? I was surprised in our reporting they haven't done this for 6 years with this entry model.
Exactly. And then there's some great quotes in this piece that if you're running with a 6-year-old model compared to the steep competition that you have in China, you're behind. So they finally unveiled it. And to the point, Tom, that you made about bright red, 2 new colors. Stealth gray and ultra red is what they're calling it.
Yeah, people know. I mean, you all know I'm a Tesla skeptic. I mean, I've tried to get Mr. Musk on the program. From the peak of 2021, we go to the Bloomberg terminal while we do under surveillance. And from the peak of 2021, Test Dog is down, is it 27%? 37% from the peak. And yet it's deemed a success right now. I mean, it's really had a good year, summer.
It has had a good, I mean, Tesla, it's synonymous with volatility, right? So to see this kind of chart, maybe on a different stock would be a little bit concerning, but they're having a good year despite it being a very tough year. They've really tried to boost sales. They're just murdering margins to do that. And whether or not it's working, it's up for debate.
We'll have to see. Alec Webb is thanking Alec Webb in London for giving us some really EV perspective here. Certainly a topic into this new September. Jobs Day. There are, I can't even count them, with ISM coming. Ferro cares about ISM. ISM out at 10 o'clock as well this morning. A plethora of data. And I'm sorry, I'm looking at the wage dynamic because I think that's what the Fed's looking at.
Yeah, it sounds like it. And just this week, obviously, all of the focus is on NFP at 8:30. But
that's non-farm payrolls.
Non-farm payrolls. But we've had an embarrassment of riches when it comes to jobs data this week. We had JOLTS, initial jobless claims, going to get NFP as well. You weigh it all together, and it It seems like the message so far is that this labor market is loosening, but I think it's the wages picture.
On radio, stay with that screen, Amy, if you would. Wells Fargo, 160,000 on down to JP Morgan. Gloomy Ferroli, 125,000. And what's important here, folks, is you're popping that monthly number of, let's take a center tendency, of 150,000 off of an employed base of over 150 million. And that's how you get the variance, is that we're looking at little teensweens numbers across, frankly, both surveys against a ginormous American labor force of 150 million. This is tough to do. I got it right once. I quit guessing after that.
Yeah. I mean, to your point that we're looking at a huge base of employed Americans,
right.
I think one of the details that's going to be important to pick out is how employed are they? When you look at the average work week, the hours worked has been going down. We know that firms have been hoarding labor. They don't want to cut back on workers. And as a result, you have people working fewer hours.
Mr. Bostic of Atlanta, speaking in Cape Town, South Africa, some important headlines shaking out about to happen on debt in the United States, and maybe that speaks to commercial real estate as well. Staying on this jobs report that we'll see in 2 hours, Sarah House joins us now, senior economist at Wells Fargo. Sarah, I was doing the math there on 150 million, which is, as you well know, the 1 over the square root of n. Okay, there's enough math for Labor Day. How predictable are these numbers this morning? Do you have a feeling you got your handle on 8:30 this morning, or is it just a complete mystery given the jumble of the American economy?
Right. So payrolls are notoriously difficult to predict. You know, the BLS says they only have a 90% confidence interval that whatever number they print is going to be plus or minus 130,000 from that number. But I think we do see, you know, we do feel pretty confident that trend is slowing. So I think we're seeing that from a range of labor market data. So not only the openings data that we saw this morning, but I think also consumers' own view that there aren't so many jobs out there with that labor differential coming down. We're seeing it in those purchasing manager indices, so not just the ISMs, but the regional Fed ones, showing that the pace of hiring has slowed. But, you know, to your point, getting that non-farm payrolls number, you know, within 10 or 20,000 of consensus, that's usually a win in my book.
And Sarah, what is the potential impact from these numbers on this soft landing debate that we're continuing to have here?
Yeah, so I think really the labor market holds the key to whether you can pull off that soft landing. So continuing to see businesses add jobs, that's helping in terms of consumers' income and therefore their own spending, while giving time for some of those supply side issues from the pandemic to unwind. And I think the labor supply story is very much a part of that. So we have seen a pretty nice run of gains, or at least steady rates of labor force participation, which given the demographic backdrop is effectively up. So I think that's helping keeping those hiring numbers pretty strong. But I think we have seen them step down, and I think a question is, you know, to what extent do we see that pace continue? Does it level off at a more sustainable pace, or given the fact that we still have tight monetary policy, that those catch-up effects from the pandemic in terms of hiring are fading, do we essentially barrel past that sweet spot for job growth and keep that recession risk elevated?
And Sarah, you take a look at the expectation for the unemployment rate, expected to hold steady at 3.5%. In a conversation we were having with Steve Whiting just a little bit ago, at what point does the slowing that we're seeing on the headline number, the pace of job growth, actually translate into a higher unemployment rate?
Right, so it's very much dependent on what also happens with participation. So if we think about just kind of the run rate to keep the unemployment rate unchanged, if you're also seeing the participation rate unchanged, it's probably only 100,000. So I think, you know, if we are getting somewhere around consensus, so around 170, we're at 160, I think that's still consistent with the unemployment rates, you know, roughly flat. If you're also seeing that strong labor market pulling workers in and supporting that participation rate.
Sarah House, I have the memory of a 10% unemployment rate. Wells Fargo doing industry-beating research based on John Sylvia looking across deciles, each 10% of the American employed public. How confusing is almost a cross-sectional decile analysis now? Is it smooth and easy to analyze the deciles of America, or is it just a jumble?
Well, you can get a sense of what's happening among different groups of workers. So really where we continue to see some of the strongest job growth as well as pay increases, it is in what have traditionally been those lower paying jobs. And so while we're continuing to add a great number of jobs relative to the gains in the population and the overall labor supply, I would say that the quality of those job gains are deteriorating as you are seeing them shift more towards lower paying sectors, and those workers aren't seeing the same staggering wage increases. So that does portend to slower growth in labor income as we move through this year, which could constrain consumer spending.
What does the hollowing out of the middle class look like right now?
Well, I think you're seeing, you've seen in terms of some of those middle wage jobs, we're still seeing slower growth amongst those, and so I think you still see that pressure. But the flip side of that too is you're also seeing, I think we talked about the lower wage jobs, but you're also still seeing decently strong growth in some of the higher wage jobs. So it's really dependent upon which way some of those more mid-skill workers can break. Do they have the time horizon to perhaps retrain to some of those higher paid jobs, or are they essentially forced to shift down and into those lower paying, lower skill jobs?
And Sarah, I'd love to bring the summer of strikes into this conversation. Of course, we're approaching a deadline for those UAW talks. When you think about some of the massive pay increases that we've seen, aside from being idiosyncratic, when does that start to show up in the data, if it does? What does that mean for wage growth from here?
Yeah, I think it means that it's going to be still very difficult to get wage growth to slow to a pace that the Fed is comfortable with on a sustained basis. So, we're seeing the employment cost index shift lower. So in the last quarter, that was up at just over a 4% annualized rate. So it's off the peaks of closer to 5%. We're seeing the same thing in average hourly earnings, at least slowing on trend. But we're still seeing compensation growth running at a pace that just is not consistent with the Fed's 2% goal, even when you factor in some of the productivity numbers, which have looked pretty decent of late. And so I think that speaks to the fact that even as we're seeing the labor market easing and beginning to loosen, that we're not necessarily close yet to a point where we can say that it's no longer exerting upward pressure on inflation, and we can really call that this recession scare has been avoided.
Sarah House, thank you so much. We'll call you back at 8:30 if you single print the non-farm payrolls number. Sarah House at Wells Fargo there before this Jobs Day. I want to take some time here, Katie Greifeld, on oil. West Texas Intermediate, 84, rounded up, up $1, up $85. I'm going to round it up to Brent crude, rounded up to $88, maybe 87 to be fair. Brent crude, basically across the summer, 74 to 87. I think this has been underreported.
Underreported. It is pretty amazing to watch that. It feels like we stopped worrying about energy prices in terms of inflation. When you think about just the headline number that we're getting on CPI, a lot of that downdraft that we've seen, you can thank oil prices and energy prices for that. Now that we're seeing this climb, back-to-back gains on crude oil, Brent oil, it's going to be interesting what this means for some of those headline figures and what this means for the Fed.
Gallon of gas peaking out at $5 a gallon. Down we go almost to $3 a gallon, a plunge there. John Tucker got the Hummer out, the H2 out. He loved it this summer. And then we've climbed back. But I don't think we've climbed back like Brent crude. $3.82 a gallon here, up from about $3 before. I mean, it's a lift. It's demonstrable. I don't know if it matters for President Biden, but I'm sorry. I've got, with all of our guests talking here, including Jeff Curry over Goldman Sachs, I got 87, 88. I wasn't there on Monday of this week.
No. And you wonder what the ceiling is, what we're going to see in terms of supply. Still a supply-driven market.
Now, my answer, folks, is look to the emerging markets. Look for the demand that we see on the Pacific Rim. Jay Pulaski of Morgan Stanley with us yesterday enthused about what we could see in oil demand. His colleague Ellen Zettner, it's 7:30. Join us this Jobs Day.
The problem with China is a growth problem and a debt problem. And the growth problem needs a revamped growth model, not just tinkering with what you have, but fundamentally changing what you have. And the debt issues need fundamental restructuring. Otherwise, pockets of indebtedness will become systemic.
George Clooney from the shores of Lake Como there with Bloomberg Opinion. Oh, it's a gray hair that fooled me. Mohamed El-Arian, as good looking as George Clooney there with Francine Lacroix at Chernobyl. It's really wonderful. I went once. It was like 40 degrees. There was sleet on the water, but it's really spectacular. It's an important meeting where people really think about the state of Europe among everything. And there's certainly a lot to think about there. John Ferro really helping us with the ECB and what we're going to see to September 14th. But front and center right now is China and the mess that it is. On this Jobs Day, we're going to digress here for a bit and talk to someone with real Beijing cred. Everybody, you go to Hong Kong, you hang out at the Mandarin, and you think you're a China expert. Or maybe you go up to Shanghai, the Peace Hotel. You look down the Bund and go, I'm a China expert. Mm-hmm. Or then maybe you actually live it. Katie Greifeld with me here. Everybody else is off today. Tom McKenzie is not off because he has lived China. He has lived Beijing. We're thrilled he could join us from Queen Victoria Street this morning. Tom McKenzie, what's the number one thing the West, and particularly ugly Americans like me, get wrong about Beijing? When you hear us prattle along, what do we get wrong about the years that you've lived in Beijing?
I think the change in dynamic, Tom, now is that the pragmatism that you saw from policymakers pre-2012 when Xi Jinping took over, that pragmatism has been sidelined for ideology and also a focus on security risks. And if you combine that with what Mohamed El-Arian was saying about the debt and growth challenges of China, the need to restructure that economy to engineer future growth, if you take on board the fact that there is this ideological straitjacket now that Xi Jinping has imposed on this economy, then that, I think, is the pivotal change. It doesn't mean, of course, that the leadership can't walk away. It doesn't mean that they can't adjust that and adapt and change that growth model. But I think the constraints around ideology is central as we weigh up the debt and growth risks.
Okay, so I'm the ugly Westerner. The car picks me up at the St. Regis. We wander down by the big red doors, and there's that little restaurant they take people like me to so we can have authentic Chinese food. The fact is, there are those big red doors. What's going on this weekend behind those big red doors in Beijing?
I think what you're seeing now and what we've seen over the last 24 to 48 hours is more coordinated response between the Ministry of Finance and between the People's Bank of China. You've had this effort now by the PBOC to allow the banks to let go, reduce their reserves around some of their foreign exchange holdings, and therefore make the yuan a little bit more attractive, try and shore up the downside that we've seen for that currency. On the other side of the table, you've seen the Ministry of Finance coming through and now implementing some of these decisions around real estate. So making it easier, for example, to get a mortgage, making the cost of getting a mortgage lower, the down payments coming in smaller in cities, the big cities like Shanghai, but the smaller second-tier cities as well. So you're seeing closer coordination in terms of the policy that's coming through. Yes, we have not seen that overarching bazooka-style policy. I don't think we're going to see it. But you have seen these additional measures. It's becoming more coordinated. And importantly, it is being implemented on the ground. Is it enough? Short term, maybe. You saw a little bit of sentiment reviving in the equity markets and the yuan today. Medium to longer term, the questions very much remain.
Well, Tom, to that point, it feels like I've woken up every single day the past week or so to another targeted measure that Beijing has rolled out. And maybe there's some signs that that's starting to work. What we've seen from the manufacturing PMIs, for example, is it's the worst of the factory slump behind us. Is it too early to say that?
I think it probably is. You're right to focus on that Caixin survey. It's an interesting survey because it focuses on private businesses and smaller companies, so not the big state-owned enterprises. That data came through with the official data, and that remained weak. But you're absolutely right. When it comes to that Caixin survey of smaller private firms in China, manufacturing back in expansionary territory. For how long is the question? and also the timing of these policy measures. The window is narrow because of the slowdown in the US, because of the slowdown in Europe. Has the window closed for these responses to come through and make a material difference when the rest of the world is slowing and demand for Chinese products arguably is reducing? That is a key question. So manufacturing remains a spotlight. Importantly, services and consumption. And the team at Bloomberg Economics are crunching the number on some of these measures that come through in the last couple of days. And they have said, look, it is going to do something to shore up consumption. We know how important that is for Chinese policymakers. They want to shift that focus onto the consumer by cutting these mortgage rates. Bloomberg Economics thinks they'll be able to do that short to medium term. They also think, by the way, it could add about 1% to GDP.
And Tom, your point about that ideological straitjacket is well taken, but there's a great story on the terminal about how the slowdown that we're seeing in China is a real opportunity for countries such as the U.S., some of their economic rivals, if you will. At what point does the data weaken to force Beijing out of that straitjacket?
I mean, that is the central question, isn't it? You know, are the policy measures, of this flurry of measures they pushed through over the last few weeks, going to be enough to alleviate some of the pain? They have a greater ability now to be able to absorb a slowing economy. When I was in China, the question mark used to be, if you get below 7%, is that when social stability starts to fray? That is the level, arguably, that policymakers are concerned about. That was the view 5-10 years ago. This is a leadership now. This is a Communist Party headed, of course, by Xi Jinping, who has, it seems, the ability to absorb more costs, more pain. You look at the unemployment numbers, again, amongst China's youth, 20% amongst China's youth. I mean, that is on a level similar to Spain, Italy, and Greece. They've taken a lot of pain. I think this is a Communist Party and a government that is ready to take a little bit more. They don't want to see that debt. They've worked through some of those debt issues. They've managed to pull back some of those shadow banking issues in the last 5 to 10 years. Yeah. They don't want to see that revived. They're not at the pain point right now. They realise that there's going to be further downside. These additional measures are going to come. The challenge remains.
We got to ruin your lunch more often, Tom McKenzie. Thank you so much. In London, Tom McKenzie leading our London coverage this morning, and of course, all of his good expertise on China. It is Jobs Day. Futures advance. Why not? What is it? 5 days up in a row? Bull market. VIX 13.47. Futures up a solid 15 as well. Thank you to Team Surveillance, and particularly the care and expertise of John Ferro for yesterday's discussion with Max Verstappen. He is ginormous in Formula One. Katie, I know you're all over that interview and what's going to happen at Monza in Italy. That's where Ferro is. I mean, he went over to Monza. Max got him tickets.
I got to say, I'm not super familiar with Formula One. Yep. I do know that Netflix show, Drive to Survive.
You been watching it?
No, I have not watched it.
Gotta watch it. Addictive.
Apparently, my brother and my sister-in-law watched it. Now they're apparently huge Formula One fans.
Yeah, that's what's happened.
I haven't seen it.
Well, Max made very clear yesterday he's not a fan. Ferro was grilling him. I mean, John was just outright rude.
Yeah.
And, Max made clear he's not a fan of the Netflix show.
Not?
He's a traditionalist. I mean, that's the kid's 25 years old. He's like Michael Jackson, equivalency within the sport, and he's winning. And of course, he won it in the Netherlands last week, and now they're in Italy, where Ferrari's supposed to win. They won't. And, Max is going to do it again, is the assumption for Red Bull. But this was a great moment, thanks to John Ferro. Really, he let me participate.
Oh, he did?
Yeah, I'm expert.
Can I say, on the Drive to Survive, I understand that this man is a traditionalist. He doesn't like it. But in a way, he should be grateful, because I'm a huge track and field fan. Yeah. I went to the World Championships in Budapest last weekend, actually. We would love a version of Drive to Survive. You have to beg people to care about track and field.
It's always been that way. I was thinking about that. NBC did a great coverage of the track and field, and it sort of preempted what they're doing with English soccer. And, I know there's a whole political thing and to do it, and there's contracts and agreements and all that. But you're absolutely right about that. It was game-changing for Formula One. And even now, folks, with I believe it's 3 races in America with Las Vegas coming up, Ferro's angling tickets from Red Bull.
Is he?
For us to go to.
We're going to do a surveillance special.
Lisa, me, John, Las Vegas. It looks good.
Yeah.
But the answer is, even with the Drive to Survive, Formula One globally is ginormous compared to what it is in the United States. Thanks to all at Red Bull yesterday for that effort with Mr. Verstappen. Back to the jobs day, and we do the data here. Futures up 14, Dow futures up 121. Yields are just a jumble. I don't know what to say about them. The real yield, I don't know what to say about it, 1.87 on the 10-year real yield. I'm watching oil. We may get an 88 print on Brent crude. That will be an important statistic. Renminbi with all the China news. 7.26 yuan. On jobs day, many coming up. Krosner coming up. Jeffrey Rosenberg of BlackRock coming up. And David Kelly, out there somewhere, is a negative non-farm payroll statistic. Stay with us from New York on radio, on television, Bloomberg Surveillance.
If you look at the economic data, I mean, it just keeps coming in, showing a tight labor market. We keep getting these numbers, strong spending.
In essence, we're seeing the economy is genuinely slowing some, but it's not falling off the cliff.
I think the equity market is focused on earnings.
We are in this sort of lull, waiting for the labor market to catch a cold so that we can actually, yes, stop this acceleration in wages.
At the end of the day, the question going forward is, can the consumer continue to live beyond means?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Jobs day. Ferro off, Bramo off, Catherine Greifeld in. She'll be doing the real yield at some point here. Recorded after the jobs report. You'll look for that through the weekend as well. And on a jobs day, a great set of guests. We'll get to that in a moment here. What we've got is an equity celebration. It continues. The Bears in retreat in August. Futures up 15. Dow futures up 119. The VIX, a bull market, 13.47. We don't have the banner, but as I mentioned yesterday, coming off the lows, the VIX from 31 flipped the numbers down to a 13 handle. That shows a shock that we've seen here. Katie Greifeld, I look at the bond market. I guess it's a churn, but with a 4.10%. Anyway here, the ambiguity or the guessiness of the bond market into October, November is wide open.
It's pretty stunning to think that in August we got to 4.36% on that 10-year yield, really definitively broke out of that range only to settle back in. It's going to be fun to see what September brings, especially for the equity market. I don't know if you put much stock into seasonals, Tom, but September is typically pretty ugly.
We got $88 a barrel on Brent crude, 87.96. We may get an 88 print there by the time we get done talking to David Kelly. We'll get to that in a moment. I want to run through the data here. We're going to do this here, an hour and a half away from jobs. Again, green on the screen here. NASDAQ up less. SPX up 0.3%, up 16 big points. Again, I mentioned the VIX, which I think is important in a slow motion holiday market, 13.47. I have to mention Bitcoin, or Greifeld will walk with a tantrum off the set.
Thank you.
And the answer is 25. It's under 26,000, plummeting off of the Gensler moment last week. We'll talk about that with Katie when we get a moment. But Bitcoin 25,992.95. I'm never going to mention the cents again. 10-year yield 4.10%. And again, over to foreign exchange, you got a churn to the market, maybe off the strong dollar moment of the last couple days. Euro 109 now 108.44. In yen, quiescent at 145.41. What's your observation today, Katie, that you see?
I would say in the conversation that we're having about oil, to bring it back to the bond market, you take a look at break even, those inflation expectations. Even though we're looking at these back-to-back gains in the oil market, inflation expectations continue to fall off a cliff, of course, as we continue to see real yields rise. There's a lot of really interesting dynamics underneath that nominal yield. You
mentioned Tom McKenzie, that great conversation with his experience at Beijing. Here is a headline. They come out, I think Beijing's on a 20-minute PR route right now. The Bloomberg headline, Beijing eases home buying mortgage rules. There have been a series of these out. We're almost up to the edge of uncountable micro headlines of what to do about an economy that's not running at 5%.
And to bring it back to that Tom McKenzie conversation, the ideological straitjacket, I thought that was a great phrase that he used, that they're so unwilling to release that big bazooka, I think is the term he used, of stimulus, and instead we're contending with this drip feed. And The open question is whether that makes a difference.
And we'll see that with renminbi right now, 7.26. A stronger renminbi, a stronger yuan, rather, I should say. Interesting to see how that fares into their Monday morning, call it our Sunday evening. It is Jobs Day. We do it right. Humbled by the guests that have shown up here across the extended American Labor Day. Ellen Zentner of Morgan Stanley, Nadia Lovell of UBS. They're on the equity market tie-in. Randa Krosner, he has been so committed to the show, the gentleman from the Booth School, arguably our greatest financial economist. And Jeffrey Rosenberg of BlackRock will look at yield here off of the jobs report. Just really thrilled with this lineup that we've got this morning. If you go back through a year, there are single moments where things stop on the show. David Kelly is trophy taking this year. A number of months ago, the chief global strategist at JP Morgan Asset Management simply said, we're going to see negative non-farm payrolls. Dr. Kelly joins us again this morning. I guess not negative non-farm payrolls this morning, David Kelly, but boy, the vector's in place. How do you extrapolate out to the shock of a negative non-farm payroll statistic?
Well, that's right. I mean, it's not going to be today, we don't think, and probably still quite a few months out. But if you look at the decline in job openings, it's been pretty significant. We've gone from 12 million job openings in March of last year down to about 8.5 million right now. A number around 7 is, I think, normal for this labor market. So as we get to that point, the sort of immunity that excess job openings has given this labor market is going to wear off. And then the labor market is going to really represent a sort of a lagged result of whatever demand we have in the economy. Now, what's been good is demand has been strong, but I still think that as we get into early next year, the risk of seeing a month with negative payrolls rises. And I think that will change the picture.
And of course, if we do get that negative payrolls print, it's going to be an interesting communication challenge, both for the Fed and the Biden administration. But I want to situate this conversation in the conversation we've been having about the economy, that soft landing debate. There's still plenty of camps out there saying that this landing will be harder than expected. But you take a look at what we're seeing in the job market. And in this economic cycle, David, is it possible that we could see a recession at full employment?
Well, a recession is when you depart from full employment. But I think what's the problem is not really a problem, but the problem is we've got 3.5% unemployment. We've had it for a year. And when you're at full employment, essentially, the economy can only grow at a relatively slow pace. And so you're basically one banana skin away from something that's going to put you into a negative GDP situation. We're not there right now. I mean, this economy has outperformed this year, both in terms of growth and bringing inflation down. And to me, the most striking thing about the Federal Reserve's forecast is we're actually more optimistic on them on both growth and inflation over the next 18 months. We think that the economy, we think unemployment could stay below 4% for a while here, and that inflation will come all the way down to 2% or lower by the end of next year. So I think that's good. But we are in a situation where, you know, as the months go on, the distortions in the labor market are gradually wringing themselves out of the system. And so we're going to be in a more normal economy with all the risks that entails.
On the topic of 2% inflation, do you need to see the unemployment rate get above 4%, or is it possible to have both slowing job growth, not necessarily fall off a cliff, but also get back to target?
Absolutely key question. I think that you can get to 2% without bringing the unemployment rate up to 4%. What we're looking at is there's a lagged effect on shelter inflation and on transportation services. As those things unwind through the course of 2024, I think the PCE deflator will come below 2% on a year-over-year basis, even if unemployment doesn't go up. And I think the key thing, why is this different from the 1970s? Because we don't have strong trade unions. Yes, you've got decent wage growth, but that's really compensation for past inflation. Workers aren't militant in demanding high wage increases, and they're certainly not getting them.
Right.
And I think that means that as the economy slows down, wage growth will moderate, and you can get that. inflation down to 2%, even if unemployment's below 4%.
This is like the David Kelly in my youth, working with Bob Goodman over at Putnam, the idea of the vibrant American economy. Let's go to the laureate Ned Phelps of Columbia, David Kelly, talking about our dynamism. There is a doubt out there about the post-COVID dynamism of the American economy. Do we underestimate, not so much fancy things like productivity, but do we underestimate the ability of corporates to adapt, the verve to keep it going?
Yeah, I think we do underestimate that. I mean, if you look at corporate profits in the first half of this year, they've really been very good. I mean, with all the strains that American corporations have been facing, to actually maintain those margins, to find ways of holding labor in place, of investing in new technology. There's a lot of excitement around AI. There's a lot of investment spending going on. A lot of companies are adapting to this environment. So yes, there'll be losers in the economy. There'll be losers among companies, but we've got a lot of vibrant American corporations, which I think can drive this economy forward.
We can rip up the script with Dr. Kelly here. We do this with Bostic of Atlanta, I believe in South Africa. And a quote from Raphael Bostic: "There are reasons why our star might rise." This is a raging nerd debate, folks. We're going to go there with the Geek Squad led by David Kelly right now. David, come on. Our start is a bunch of plugins. We don't know this. We don't know that. Are you looking for us to subsume, as John Williams says, and get back to a historic lower R starred, or can we reset constructively higher?
We should abandon R star altogether. The R star is the idea that there is a specific interest rate which holds this economy in balance. But the truth is at low interest rates, the impact of interest rates themselves on economic activity and on inflation is very minor. So why are we so fixated on setting it? I think really what happens is the Federal Reserve overshoots on both directions on interest rates, distorts financial markets, causes long-term problems without actually properly modulating the economic activity. So we should stop trying to aim at an insignificant little distant star like R star. The level of interest rates is not significant enough in predicting economic activity. It just causes distortions. The Federal Reserve ought to try to get back to a more normal level of interest rates and not distort financial markets by trying to over impact the economy with a variable that is really just not that effective.
Bottle it, folks. That dissertation from Trinity Dublin and David Kelly was classic. We'll have that for you on Bloomberg Digital and, of course, across all. That was a wonderful effort by Dr. Kelly to explain a school of thought that R starred is basically a jumble of mathematics. That was really, really an important statement by Kelly of J.P. Morgan. Katie, I can't say enough about what Kelly just said there about the math frenzy of American economics. That was the gentleman from Ireland talking.
Throw it away. Abandon our star.
I don't know if I'd abandon it, but I'd lose it as a study point with, as Olivier Blanchard of France says, there's enough other factors out there to make your head spin as well. That was a brilliant moment of our September here. Right now, on a jobs day, the Standard & Poor's 500 up 0.3%. We welcome all of you on radio and television here on Jobs Day. Ellen Zentner coming up, Randall Krosner coming up. We take a minute here on Bitcoin. You mentioned earlier the SEC, Gensler having a tough time. Did the people that want to package Bitcoin into investable products, did they have a good August?
It was a good August. It came at the very end, even though there's plenty of more hurdles that we have to cross to get to that spot Bitcoin.
I can't buy a Bitcoin ETF by Christmas.
You could if you go to Europe. If you want to do it in the U.S., it might be a little bit difficult. It's not just Grayscale who's trying to do this, though. You have some of the heaviest hitters out there, BlackRock, Invesco, Fidelity. They all have applications for this type of product. So what happened this week, it wasn't approval, but it was a needed step to get to approval.
So what's the next step here? What's the next judicial step here? Does it, to use the theater, go to the Supreme Court?
Leaving aside what's going on with Grayscale and the SEC, the fact that we do have active filings from BlackRock, from Invesco, the list goes on, the SEC has to respond to those. They actually had a deadline this week. They've already delayed that decision. They can do that, and it was expected. The next date to watch, I believe, is mid-October, is the next point at which they'll have to respond. So we'll see. There's a lot of paperwork. There's a lot of meetings to be done at the SEC between now and then. It's going to be a fascinating fall, at least in the Bitcoin community.
So you're going to stay through 8:35 now that we've done the required Greifeld crypto quota?
That's my plan, yeah.
Oh, her agent is trouble, I tell you. Futures up 16, Dow futures up 122, the VIX 13.45. It is Jobs Day. Important to listen to Ellen Zentner, the chief U.S. economist at Morgan Stanley. Stay with us on radio, on television. It's Bloomberg Surveillance.
We don't have shared values, but we have a shared planet, and we have to work with the Chinese to save the planet, because they're now, I think, the biggest emitter. If not us, they're second, and they're part of the solution in all of this.
Nancy Pelosi, as we said earlier, a changed Nancy Pelosi. She was Speaker of the House with the weight of herding cats, and now it's a very different Congresswoman from California. Important comments there to Bloomberg, not only on China, but also her hope, as she sees it, that a Republican Party will find a path after former President Trump to something that she remembers from her youth. Katie Greifeld is in today for Lisa Abramowicz and John Ferro. Thrilled. Thank you so much for watching today. It was some great guests lined up here to get to Jobs Day as well. I just had an email in. Yes, we'll continue to cover Bitcoin. Thank you for that oddity of the price to get Greifeld on. Futures advance up 17. They continue to advance. We're in a bull market, 5-6 days up in a row. I noticed Apple doing well just as a market bellwether, 4.10%. And the 10-year yield. That's not Brent crude. For those of you on radio, you look at TV and your eyes cross over. That's 84.75 on American oil. West Texas Intermediate up 1.3%. Brent crude, I'm pennies away from an 88 print on Brent crude, and that may be the quiet story into the weekend off of the jobs report. We're going to go tangential, rip up the script as we can always do with Anne-Marie Horton, extremely well read in on Bloomberg, on Washington, I should say, and our Bloomberg Washington correspondent. Anne-Marie, very quietly, in the Washington Post leads this morning. I'll read the headline from Nick Murloff. Families crossing U.S. border illegally, and here's the money quote, reached all-time high in August. I believe this has slipped by the summer, Anne-Marie. How upsetting is the immigration story in Washington on a sleepy September 1st?
Well, I don't think it's really slipped by the summer if you see what's going on, one, at the border, and you see constant calls from especially the Republicans who want to make this a campaign issue going into the 2024 presidential election next November. But also we have seen recently really the escalating tension between top Democrats in the party. I'm talking about the Biden administration, and New York City Mayor Eric Adams for months has been asking the federal government for help with migrants that are in New York State. He's now joined by Governor Kathy Hochul, as well as some top business leaders, writing a letter to the government asking for more help. You do see the government coming out and looking at federal buildings they can use. I think one of them is a tax office on Long Island. But they are asking for help because the city says it's going to cost them billions of dollars, and they are just running out of space. It's a fractured moment you see between top Democrats, very interesting, before the presidential election. But potentially this problem is going to get worse because people are feeling like they are running out of resources.
Are the both parties on the same page? Is it like China where there's a bipartisan panic? In this case, over immigration, one statistic going from 100,000 arrests in June on the border up 70% to 177,000 arrests. Is there any sense of bipartisan, or is there the normal polarity?
So I think when you think about immigration as a whole, when you talk about any sort of chance of bipartisanship, it comes back to individuals who want to see really a remake or revamp of immigration law, and they want to make sure they're getting this under control. But Republicans daily bash how the Biden administration is handling the border. Even something like what the Trump administration wanted, build the wall. not much of that wall has been built. Some are still campaigning they want to finish building that wall. That is something that the Biden administration is not going to do. One thing you saw the Biden administration do, especially when the president went to Mexico, is they're trying to house more in Mexico before they come over the border. But this is a very difficult situation, and if migrants come in and they make it to places like New York, it becomes a humanitarian situation. So it's incredibly sad. It's incredibly difficult. But I would say the bipartisanship really only starts and ends when it talks about revamping immigration law. But how you deal at the border, there's a lot of stark differences.
Let's talk a little bit where there is some degree of bipartisan agreement, and that's with China. Of course, U.S. Commerce Secretary Gina Raimondo wrapping up her trip. And Anne-Marie, it seems like she's leaving with more than we've seen from past trips from Biden administration officials this summer.
Well, she's leaving with this opportunity to have a more frequent dialogue, I would say, with her Chinese counterpart, as well as a working group that'll be set up to talk about the commercial ties between these two countries, which she really wanted to emphasize that could be the bedrock of this relationship, because obviously you see China and the U.S. spar when it comes to export controls and sanctions. And there's also going to be another dialogue when it comes to those export controls so that China feels like they truly understand what is going on. I would say, though, there was a bit of a wink, wink, nod, nod that happened on her way out of China. And that was when Huawei released a 5G phone that many are saying Bloomberg hasn't been able to independently verify what actually went into this phone, but it blew up in Chinese media. And it really showed that Huawei was able to circumvent the sanctions that are placed on them to develop this phone. Remember, they were put on the entities list in 2019 by the Trump administration. They've been a major target from the United States. So that was a little bit of the timing, I thought, was suspect, coincidental, or potentially on purpose.
Yeah, and it's an important reminder that there's still a lot of distance between the two sides here. Let's talk a little bit about the top brass. When we think about President Joe Biden, a potential meeting with Chinese President Xi Jinping, walk me through this. I thought that they were supposed to meet at the G20 summit this month. It seems like Xi Jinping is planning to skip that now.
Yeah, it does look like Xi Jinping is not going to be attending. Reuters reported this, and then we've reported that China has just not given their response yet, their RSVP, if you will, to the Indian government. It does look like Xi Jinping is going to skip it. And then in another potential dagger to the United States, in October, a month after the G20, we've reported that he's invited President Putin to come to China. This will be Putin's first trip out of Russia since there's an arrest warrant after him for alleged war crimes by the International Criminal Court. He'll be attending China's Belt and Road Initiative. So this was going to be an opportunity potentially where Biden and Xi Jinping, even if it wasn't a full sit down, the way they had in Bali, that really restarted the talks, and what the Biden administration wanted to see, more healthy dialogue between their cabinet members and Chinese ministers. We won't see that there then. But I still maintain, to be continued till the end of the year. The United States is hosting APEC, and there is a chance Xi Jinping will attend that in November. So that would be the really last opportunity of the year for these two individuals to sit down.
Anne-Marie, thank you so much. Anne-Marie Horton with us, our chief Washington correspondent here. And, of course, Balance of Power, look for their efforts here into the powerful September that we have ahead. I really want to draw your attention to the equity markets, and I think we need to frame out where we are. There's been so much gloom that we've seen. And just to give you some perspective here on what Standard & Poor's 500 has done over the summer, and particularly, Katie, going back pre-pandemic, a lot of the pros are gauging now, and this is unusual because of COVID, but they're sort of saying, okay, where was free cash flow pre-COVID? Where's it now? And the answer is bouncing off the bottoms of October, the bull market that we're in, or gauging it to where we are from the peaks here in the recent weeks. The answer is it's been pretty good. Back 4 years. Do you feel like the Standard & Poor's 500 is up 13% per year pre-COVID?
Pre-COVID?
I don't think the feeling's out there.
I would believe it, though.
there it is. I mean, 7 stocks, but it's a lot more. But that's a really substantial return now, hard to believe, across 4 years as well. I did a comparison with Apple as well. I mean, everybody talks about Apple. Thank you to Dan Ives for real wisdom. My eyes are hurting still from when he came in. Apple, under the same guise, up 37% per year.
And you think about how consistent Apple is, and you talk about free cash flow, and Apple has, more cash than Ireland? I forget what the current stat is, but that's a company you can rely on to continually deliver. But
there's some real suspect here into September. Our Mark Gurman leading our world-class coverage on Bloomberg. Everybody hangs on what Mr. Gurman says, and of course, all of that will move to September with Bloomberg Technology on Bloomberg Television as well. On Jobs Day, Ellen Zentner next. This is Bloomberg. Good morning. One hour away, the jobs report for August, hugely anticipated, along with an inflation report coming up in a number of days as the Fed staggers to a September meeting. I guess it's pause, but who knows? We are data dependent. We'll be data dependent in 1 hour. Randall Krauser coming up, the former Fed governor as well. With the importance of our guest, we're going to get right to it here with futures up 17. Nice lift to the market this morning. Let us go under surveillance with Catherine Geifeld joining us this morning. Is everybody except me and Damian Sassauer. Sassauer's working. Did you know that?
From home.
He's work from home. We'll get to that in a moment. Sassauer's work from home. Anne-Marie Horton wasn't work from home.
No,
She's
that was a nice
office.
Studio shot.
We'll get to that in a moment. It's a backdrop she has. She's actually working from beach as well. China has been part of the story here, ramping up efforts to boost the yuan. They were successful by 3 decimal points, 7.26 right now on yuan. But it's a steady drip. We're still, I would suggest we're in still the single headline, so what mode. There's no drama here.
No drama. It's interesting to see them come out in support of the yuan once again. They've really ramped up support specifically for the currency. Remember all of those fixings that we got that were super strong. Now we're getting the reserve ratios starting to move a little bit. We'll see if that works. I mean, China yuan weakness has been the story of the summer.
And right now, to move on to a next view here under surveillance, and this is really cool. How about spanning from northern Western Australia? You go up from Perth, and you go way up where the snakes are, and then you go out a zillion miles, like 50 miles out, and there's an island which is like LNG Central. Mm-hmm. And they're having problems in Australia is unionized workers, they rejected a pay offer from American Chevron in Western Australia, and that affects globally, including Europe with Ukraine. This is not a small matter.
Yeah, these 2 Chevron facilities account for about 7% of global LNG supply, rather. And we talk about strikes in the context of the American economy all the time, but this is a really important reminder. This is becoming a global issue that we're talking about.
Right now, we're going to sit on this for a moment before we get to Ellen Zentner. And the basic idea is everybody is sort of trying to figure out 2024, beginning September, Labor Day, in America, what's the new work from home? Wall Street's looking to get workers back in the office as the summer close. Beautiful grid by Bloomberg of what each is doing. Each firm has their own attitude. James Gorman at Morgan Stanley, like the accent got going, he was getting a little angry there. And he said 2 things. He said, if they can have dinner in Soho, they can come to work. And he said if they can stand in a trout stream, they can come to work. I mean, I thought it was pretty good.
Well, you think about what Jamie Dimon said.
What did he
said this to The Economist in July. Completely understand why someone doesn't want to commute an hour and a half every day. Totally got it. That's a direct quote. Doesn't mean they have to have a job here either. It's a pretty hard line. Yeah,
it's getting a harder line. I think the tendency here, seriously, folks, and this is, of course, a huge topic for our Manhattan, but the intensities picked up on September 1. So
today, actually.
Today, yeah. I think today is the day where we launch out here, and it's past Labor Day and into Wednesday and Thursday next week. Leading the charge, I would say, is Goldman Sachs. King Solomon has said, get in the office.
Yeah.
And it's as simple as that. We don't have any sympathy, do we?
We're here every day. I don't know. We might have differing opinions here. I know that Paul Sweeney
might
everyone back in the office. I think hybrid work.
There's a little tension with Greifeld, different opinions on crypto, different opinions on work from office. Helping us here with the new labor economy is Ellen Zentner, who was in the Troutstein when Gorman said, Ellen, get back to work, which she has done. She's working 7 days a week for Morgan Stanley. I want to get to Jobs Day in a moment. What's your guesstimate on the impact of the American economy of work from home?
Work from home, I think, can have some real benefits to productivity. I think we're forgetting
Nick Booth
that
at Stanford agrees.
Yeah, and I believe that there is a chance for women that would normally have low labor force participation rate to increase labor force participation because of the flexibility that it offers. I think that there's a chunk of the population of disabled folks that could work more fully. Or have work opportunities given the flexibility.
And what's the problem
home.
Wall Street is? I don't want to get in trouble with Fortress Gorman here, but you were down in Soho having lunch and James is going, what is she doing? What's the problem with Wall Street CEOs? They all have 4 houses. They have a helicopter. They're like, well, should we be in the Hamptons or up the Hudson River? And everybody else is disabled or can't work. I mean, what's the attitude adjustment that there needs to be across all of corporate CEOs?
I think that for me, I make individual decisions for my team. And I was very flexible before COVID, and I remain flexible now. But that flexibility doesn't mean that you don't come into the office and interact with folks. And especially for the younger employees at the firm, the younger employees understand that they need that connectivity. And they want to be in. And so I provide an example that when I'm not traveling, I'm in every day. But do you have to be in if you have kids to drop off at school? Is it perfectly acceptable to be in a bit later? Can you finish work at home in the evening if you didn't get it done during the day? Can you extend your vacation for a week and then work from there for a week? I love those arrangements, and that is a good deal of flexibility.
I gotta say, I love everything Ellen is saying. I think it sounds...
Now, come on, be a journalist, be fair and balanced, Kate.
Fair and balanced, but I think you make some great points. Let's bring this to what we're going to get in less than an hour.
Nice segue.
I'm trying here. We're going to get the jobs data, and aside from the headline number, what we're going to see on wage growth, I'm sure we're going to talk about that. But talk to me about labor hoarding. That's a dynamic that started to pop up. You have employers cutting back on hours versus shedding staff numbers altogether. Is that the typical dynamic we tend to see at this point in a labor market?
Not to this extent. And I think it started with earnings transcripts last year around March, where we started to see hints of this. And so part of our stress back then that we were going to see a soft landing was that we would see job gains slow but not fall off a cliff, because companies then have increasingly told us and are still telling us, I'm going to hang on to my current headcount. I can control costs by reducing hours. I want to be prepared for a pickup in business later on because it's been so difficult to hire. So what does that mean? It means right now you look at the JOLTS data that came out this week, job openings are down sharply, right? But quits are also down. Firings are down. There's very little churn in the labor market, which means you're taking pressure off of wage growth. But it also doesn't mean that jobs just fall off a cliff. They're going to continue to slow here.
Is that dynamic masking what we're seeing at the unemployment rate level? Because at the same time, we're seeing the average hours worked go down, but the unemployment rate is not budging.
Yeah, so I think... Look, an issue for policymakers now is to say, where is the appropriate level of unemployment? We've seen some start to say maybe it is very low. I think one of the most encouraging things that I think Chair Powell is very happy about as well is that they've been able to start inflation in the right direction. They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate or raising the unemployment rate at all. Yeah. And that's a Beveridge curve effect. The Beveridge curve, which relates job openings to unemployment, is normalizing. It's normalizing. And so we're able to bring those job openings down without raising the unemployment rate.
Your initial acclaim, which I was privileged to witness, was on consumption, on retail. We're sitting here with grim, broader American retail sales in that. Give us your consumption dynamic right now, the retailness of America.
Yeah, so I think, Sarah Wolf on my team, who's our consumer economist, loves talking with you, Tom, and has been on this show before. And look, the consumer bottom line has been stronger than we expected this year. There are factors that have been pushing that. You've got very lumpy, volatile categories of motor vehicle sales, which is just a supply issue and pent-up demand issue, right? Pushing up spending. But underlying that is deceleration in discretionary spending this year. It's that undercurrent of lower income households have been having issues. They don't have the excess savings. Their wage gains are, though, still turning positive, finally, because inflation is coming down. So consumer spending, and this goes into the soft landing as well, is slowing. It has been more resilient. We've released recent research on the Barbenheimer effect, the Taylor Swift Eras Tour, and Beyonce.
How many times have you seen Taylor?
So I have not. My niece did, and I hear I'll be able to see her in the theaters in October. I mean, she has been a juggernaut this year. And look, we all go to concerts. People go to concerts, and we've had this increasing demand for experiences. And yet this was extraordinary. I mean, she is a juggernaut that has generated revenues on the order of the Olympics. Yeah. Beyonce as well. I mean, there's about $1,500 per person spent to go to those concerts.
What's your number on unemployment where behavior changes to 0.1%? Is it 4.0? Is it something round about 4? Is it 4.x%? Where does our behavior, our construct of labor change?
Yeah, so I think it comes more, and on the part of households, it comes more on what are they hearing from their neighbors? What are they hearing from their friends? What are they seeing with their coworkers? We've already seen, without a deterioration in the unemployment rate, we've already seen that assessment of households this week from the Consumer Confidence Survey really plummet. And so either they're going into the labor market right now and having a tough time finding jobs, or they're hearing that from their neighbors and friends. And so I don't think we have to have a tremendous amount of increase in the unemployment rate for folks to really start to buckle down and get worried about their future finances.
And Tom, I'm sorry, I do want to go back to Taylor Swift for just a minute. And I have a good reason why, because Anna Wong of Bloomberg Economics actually put out a piece that said a Swift summer papers over cracks in the job market. And to your point, it's been like the Olympics. She writes that basically this demand, this surge in demand that we've seen for leisure and hospitality workers, that's partly driven by Taylor Swift's concert tour, and that's going to fade.
It is going to fade. And so research that we released this week showed that, okay, you have Taylor Swift, Beyonce, Barbenheimer all hitting in the third quarter, peaking in the third quarter. Now Taylor Swift moves on to take Europe. But in the fourth quarter, that fades. It fades. And now these one-offs doesn't mean that the undercurrent is super soft for the consumer, but you are going to have to deal with that. And we think that consumer spending is going to decline in the fourth quarter.
You don't think after Barbenheimer, the March meeting of the National Association of Business Economics is going to pick up the GDP slack?
We try.
We tried.
I try. I shop all the time. My husband will tell you. I'm insatiable. Right. I really try to do my part.
Ellen Zentner, the newly minted president of the National Association for Business Economics, selling the religion there. The religion on Jobs Day is simple. Standard & Poor's 500 up 0.4%. On radio, on television, Ellen Zentner with us right now with Morgan Stanley. I want to dive into the granular nature of the report. What is the character of our unemployment right now, and particularly temporary workers versus full-time workers?
Yeah, so temporary workers have been picking up, and that can pick up for good reasons or worrisome reasons, depending on where you are in the business cycle. And so temporary workers, when they're picking up, either you're unwilling to hire full-time because you're uncertain about the economic environment, or it's the start of moving from temporary to full-time. So we're really focused on that. Do we continue to see temporary employment decline in today's report? And what does that mean? Is it worrisome, or is it something of just normal? Are they moving to full-time?
This is a spectacular window, folks, into the ambiguity of the two roads. I've always, in my study of this, particularly with Federal Reserve Bank of St. Louis, is it's hugely ambiguous what you do. People talk about temporary jobs with certitude, baloney. We have no clue what it's going to be.
Yeah, well, I think that's why each time one of these large reports comes out, it is always a mixed bag, and there is something for everyone in it. If you're a bear or a bull, you're pessimistic, optimistic, there is something for everyone. I'll tell you, you said something at the beginning of the show that the Fed was going to stagger into the September meeting. I think Chair Powell could swagger into the September meeting because whatever the data does, they've got time on their hands, an incredible amount of time to follow the data.
Very good. Ellen Zentner, thank you so much for joining this morning. She is with Morgan Stanley. She's lifted the markets. Only Zentner can do that. Taylor Swift and Zentner can do it. Futures up 17, Dow futures up 135. Stay with us. It's Jobs Day in 45 minutes. Krosner, next.
A 10% correction is not totally unlikely if the economy starts to soften up globally and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
Nouriel Roubini is not as good looking as Amal Clooney, Rita Ora, the former speaker, Nancy Pelosi, all attending in Venice, Italy last night with Francine Lacroix, the 2023 DVF Awards. This is Ms. von Furstenberg, and this is a real lineup of ability in Venice to close out the summer. And of course, Francine Lacroix must attend on her way with the Clooneys up to Lake Como to just, do what they do at Ambrosetti. Mohammed El-Arian has told me this is the greatest junket of all time. Serious conversation about Italy, about finance, and about Italian banking. Pulling the most difficult job on Labor Day in America from Lake Como, Italy, and Cernobbio, our Francine Lacroix.
Yeah, Tom, I'm on an Italian road trip, but only to the glamorous places. But we also have to get back to business and talk banks, because there was a little bit of thing called a windfall tax that was unannounced and then suddenly announced, and the markets freaked out a little bit. So I'm delighted to be joined by the Intesa chairman. He's Gianmaria Grospietro, to talk about the bank that the markets frankly didn't take so well. Chairman, thank you so much for joining us. I mean, this was a surprise. It must have been a surprise for you. You're one of the biggest banks in Italy. What was your reaction to the windfall tax?
Well, it was a surprise, but not a terrible surprise. I don't think that the windfall tax will be dramatic for the Italian banking industry. But the reaction of the investors was not expected, even by me, because the consideration of the Meloni government has always been positive. It is considered reliable. Now the investors have been spooked by something that they didn't comprise completely. That was the problem.
But the investors were spooked, and then they said, okay, I understand. So for example, for Intesa, they may lose up to $1 billion. They may maybe change a little bit of what they give back to shareholders in dividends, and then they've moved on. Is that how much it will cost you, $1 billion?
I think that with the new correction that has been already decided, we will be below 1 billion. But the fact is that at this moment we do not know what will be the final situation, because the Parliament has 2 months for approving or modifying the decree that is till October 8th.
So what are you doing at the moment? Are the Italian banks lobbying the government? What would be your best outcome in this kind of scenario?
I don't know. I don't know, because there is an active debate on the political side. And in this moment, the question is a political one. So we are only spectators. But anyway, I have the opinion that this will not a dramatical effect for the Italian banking industry. Indeed, the situation is good. The economy is doing well. We have experienced a slowdown, but not grave. The Italian economic structure is good. The family, the household savings are good. So.
For Intesa, could it actually change the way you look at dividends and giving back to shareholders?
Well, if we have a lower profit, we will have lower dividends, of course. We have given a dividend policy of 70%. So that is the question. But anyway, dividend will be good in any case. So I think that our shareholders will be satisfied, especially because we are not only producing dividends, we have an industrial plan which is made of concrete targets. We are facing a twin transition, digital transition and climate and technological transition. So our investors, our shareholders are satisfied. We are doing something concrete.
Chairman, talk to me a little bit about interest rates. So they've gone higher quite a lot. Is there political pressure to actually give more to savers? And how will that change the business models, not only of your bank, but all European banks?
Well, dividends and interests are a commercial fact. There is a market. What I think is good is that the market is competitive, and competition is rising, also in paying deposits, but it's rising especially on time deposits. And there is a movement from sight deposits to time deposits, and this is a sound movement, both for the depositors, for the customers, and for the borrowers and for the banking industry, because time deposits is the right way to finance lending.
Tom Keene calls me up every week, our co-anchor in the US, and he asks me, what is stagflation in Europe going to look like? You paint a pretty optimistic view about the economy, but do you worry about low growth and high inflation that we cannot control?
Well, we have experienced a slowdown in growth, but Italy has done better than France and Germany, and we have very resilient SMEs. We have an economy which is more distributed with export destination and sector destinations or sector specialization. So we are very positive also for NPLs. We don't see difficulties in NPLs.
But the government here in Italy is also trying to change Italian capitalism. Whether it's small or big, do you worry that international investors will be much more wary of investing in this country?
No, I don't think that this country will be abandoned by international investors because the yield is very good, and the government has been very responsible both in the economic policy and in the foreign policy. That has been appreciated.
Gianmaria Grospietro, thank you so much for joining us. As always, that was, of course, the chairman of Intesa. With that, Tom, I'm going to send it back to you, but look at this view. It's difficult, right, sometimes to talk about bad loans and banks when you have such a beautiful view.
Francine Lacroix from Venice to Lake Como to who knows where next, maybe Saint-Tropez for the weekend. Francine Lacroix there, of course, and look for Leaders with Lacroix each and every month out on Bloomberg, out of London, Queen Victoria Street as well. It is Jobs Day. There's a lot going on, and people are publishing and working today. Torsten Slok over at Apollo is not work from home, and it's just really, really simple. He's got an incredibly terse note here. And Katie, this is something you follow every day. Katie Greifeld in for Lisa and John this morning. Real special Jobs Day. Slok. Since the Fed started raising rates, deposits in the banking sector have declined near $1 trillion. Over the same period, almost the same amount has gone into money market funds. And the chart he's got, which, doesn't matter what the chart is, all you need to know, this is a melt-up, Katie Greifeld. From my ute, this is a huge, huge deal.
It's a huge deal, and it's a huge issue for those smaller, mid-sized banks that have to pay up to keep these deposits. You remember that double downgrade that we got from S&P and Moody's on those regional lenders in August? It was the deposit issues that they really highlighted. Even though we're past peak panic that maybe we saw in March, that deposit story, the flow of deposits into higher yielding money market accounts, it's going to be a slow-moving but big issue for these banks.
And the other thing we've got is Citigroup out moments ago, the Holland Horse Combine. I mean, he's got like 42 people working for him. And the question is strikes. You mentioned UAW, and there's I think they get less cred, less respect, but the actors and all that. I mean, Vet Bill, my dog, Vet Bill, he's got a SAG card. Vet Bill's on strike. He's not crossing the picket line on Fifth Avenue. But the bottom line is Citigroup looks at a 40,000 drag just from the LA strikes.
And then you think about the impact on wage growth too, those wage pressures. It's pretty amazing.
We're a half hour away here. We're going to get into this and really move on. Promise me, 8:31, you're not going away. Jeffrey Rosenberg will be upset if you leave at 8:31. It's Jobs Day, Bloomberg Surveillance.
For right now, we don't see enough evidence that a recession is imminent.
Earnings are going to have to drive things for the stock market in the U.S.
I don't think that we'll be seeing the Fed cut drastically.
Maybe this September meeting is a skip, not a pause. Maybe we will go again in November.
We still think they're probably going to hike one more time in November, but that's probably going to be the end of the cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's Jobs Day in America, the Super Bowl, 13 times a year, the game. And then also each and every month we have Jobs Day here, and we'll go beneath the headline data as we always do. The same lineup as always. Thrilled at their commitment here on Labor Day. Krosner of Booth School. They're already back in school. It's no big deal for the former Fed governor to be on the show today. Jeff Rosenberg will join us here. I'm not sure which beach he's coming from. Nadia Lovell will be with us here in moments with UBS as well. And we celebrate, speaking of Nadia Lovell, Katie Greifeld in pulling the shortest of short straws here on Jobs Day. Futures up 15. I mean, the equity market just advances.
It just advances. I don't know what changed in August. Maybe it's just summer trading. We'll see if that momentum continues as we really get into the meat of September. I don't know how many people are going to stick around after 8:35 today.
Well, we're going to convince him to stick around. Jeffrey Rosenberg will help us get out strong here in the half hour. We'll do our uninterrupted coverage here coming out of the jobs report to give you a brief here forward into September. I want to go to the data check right now and do it across equities, bonds, currencies, commodities. Let's flip it here. Katie, commodities, I mean, front and center. I have 87.89 on Brent crude.
I know. It's been a pretty incredible move in the energy market. For a while, it felt like there was one way to go, and it was lower. Again, we do have some important meetings, some important decisions coming out of OPEC when it comes to potentially extending those supply cuts. Obviously going to make a big splash in that market.
Real tight market here, and demand has been effervescent compared to the gloom of a number of months ago. 7:10 Wall Street time this morning with 88.02 on Brent crude, which shows that story into September has some legs to it. In the currency space, I got a churning dollar. I'm sorry, 103.67 on DXY. Nobody expected that 31 days ago. Yen goes 147 into stronger yen, 145. Euro 109 gives it back to 108.33. What do I look at? I look at Euro Swissy, even on Labor Day in America, and that shows me stable Swiss franc. The angst is not there in the foreign exchange market. And as we get to the real yield, this was founded by Jonathan Ferro many, many decades ago. The real yield now picked up because of Ferro's burdens is picked up by Katie Greifeld. You got a 185 in the 10-year real yield. To me, that is the story into the Fed meeting.
It's pretty interesting to see that move. And I remember when we were at extremely deeply negative real yields, there was a lot of ink spilled over what's it going to mean for the equity market when we get back to positive territory. And we're at, decade highs and then some right now, and it doesn't seem to be making too much of a dent.
I don't want to slow the show down with how you frame that. Ian Lingen did it yesterday, and he said, what he said is simple. price up, yield down by the 10-year yield. That was a market call yesterday from BMO Capital Markets.
What did he say, 3.5%, 3.75?
Price up big time.
Yeah.
Plus, you're going to be in a zero coupon bond. You're going to be in the Austrian piece out 97 years and make some real gain on that. Futures up 16. On Jobs Day, we start with the impact on the equity market. Nadia Lovell joins us, senior U.S. equity soft landing strategist at UBS Global Wealth. Nadia, thank you so much for starting us strong in this hour. Soft landing. Nobody saw the last 6 days coming in equities, and yet UBS did. Why do you have to be in the market now to participate for capital gain?
We continue to think, I'll give a nod to John Ferro. We think that we're sort of in this phase of bad news is good news again, in the market. And, we've seen some of this play out this past week in terms of some of the disappointing macro data, but still enough to point to our soft landing. We're seeing a repricing in the bond market, and so that's given some reprieve to the equity market. But we don't want that to go on for too long because that will call into question the soft landing scenario. We do think that the market is going to oscillate right here in this sort of narrow range because we do think that peak in the growth momentum is behind us, and we are looking for an economic slowdown, just not a recession. We do think that is going to limit the upside to earnings from here.
Totally unfair off 6 days of analysis, but can you state on 9/1/23 that we have a broadening market?
Yes, that is our view. We think that the market will broaden out. We continue to favor some of those areas of the market that have lagged year to date, where valuations are more reasonable. We think that you're going to see some churning under the surface, even though we think we're going to be in a range-bound market, where you're going to see some cycling out of those expensive areas of the market. You're already starting to see that in the last 3 months. If you look at the equal weighted index, that's starting to catch up, favoring industrials and energy as part of that.
You see how Nadia Lovell just put me in the timeout chair? She knows I didn't read her note, and she knows Katie Greifeld read her note. Why don't you save us here?
I did read your note, Nadia. I do want to take a detour, though, and talk a little bit about cash. You talk about your allocation to fixed income, but I want to talk about the very shortest end of the yield curve, because you look at the flows into money market funds. We got the updated data yesterday, nearly $5.6 trillion in those money market mutual funds. Do you look at that and say, that's all cash on the sidelines, that belongs to this equity market?
I think it belongs to both the equity market and the fixed income market. What we've been advising clients to do and what we've been doing in portfolios is really extending the duration. We've seen that backup in bond yields over the last couple of months. We didn't think that that was sustainable. And so we actually have been extending duration, favoring the belly of the curve. So we continue to see opportunities in that 5 to 10 year range, particularly in government bonds and high grade investment grade bonds. And so that's what we've been doing, because eventually we do think that bond yields are going to come down. You want to lock in those yields. We're looking for the 10 year to come down to something with a 3% handle by the end of the year. As the economy is slow, we're looking for 3.5 to 3.75 range. And then when we look into June of next year, we think that you're going to get to 3 to 3.25 range. So locking in those yields at this point is very important, and extending that duration.
Well, walk me through that thought process when you're thinking about the belly, when you're thinking about benchmark 10-year bonds. Is extending duration right now basically a call that basically the Fed is going to cut, or do you see the economic environment turning here and maybe we start talking about a recession?
We don't see a recession in the near term. I would say at the start of the year, we were more in the camp of likely a recession, but the consumer remains strong. And so we think that that can be extended. There are pockets of weakness, but we think that the consumer will remain resilient. So this is more of a call of inflation coming down faster than expected. We're already seeing that in core PCE. If you look at that, that's actually on trend to come down faster than what the Fed had penciled in the June SVP. The Fed expected like 3.9% by the end of the year. We're only 30 basis points off from that. So we think inflation is going to come down faster, and that would allow the Fed to cut in 2024. And that's what's going to drive bond yields on the long end of the curve lower.
Nadia, we got a jobs report. And so much of it in the angst that's always within the report, even if it's, sub 4% unemployment rate, is a staggering middle class and, people struggling at the low end of the spectrum. And that's witnessed recently with retail. Just to be direct about it, retail craters. Is retail for you, equity retail, XRT and the rest of it, is it a value opportunity now, or is retail a value trap?
I think you have to be selective in retail. We think that there are some value traps in that segment, but there are some opportunities. If you look at the consumer, yes, the consumer, the lower end consumer has been feeling the pinch for a while, but the reality is the consumer is still spending. I mean, we saw that in the Visa credit card data this past week that points to the consumer still spending, but just being choosy, Tom, on where they spend and how they spend their money. If you look at e-commerce, you're seeing continued acceleration in that, as well as cross-border based on the Visa data. So you want to be focused on those companies that have an e-commerce presence and also more in the leisure space than sort of those traditional retailers.
I can't emphasize enough, Katie, how important that insight is. We're not doing buy, hold, sell on Amazon, but this e-commerce partition here is as newsworthy as it was 6 months into the pandemic.
And Nadia, when you extrapolate that forward to retail's basically pricing power, how much is left at this point, and how is that different between an Amazon versus a brick and mortar shop?
We think that the pricing power is dwindling. I mean, we're already seeing that even within the consumer product companies have been talking about it throughout the earnings season, that it's becoming tougher to pass along that additional price increase. And so that's something that you have to be mindful of, that the dwindling pricing power, particularly as inflation comes off and the consumer excess savings just get exhausted.
Nadia, John Stolfus, the Uber bull on a couple days ago. Help me out here, Nadia. SPX 5000, 2024?
2024 for June, we're looking for that to get to 4,700.
Oh, you're killing me. Nadia Lovell, thank you so much with UBS there. In the markets. You got to be in the markets, folks, to participate in the game. That's a religion of Gina Martin Adams over at Bloomberg Intelligence and Nadia Lovell over at UBS. I can't emphasize this enough, Katie. And, you think of market timing in Bitcoin. I mean, where did we go to, 66,000 or something? How many people got out at 60,000?
Oh, if you just look at the chart, it looks like a lot. And they haven't really come back. But yeah, that was November 2021.
Well, this is important. I'm not aware of this. There's not an effervescence right now in Bitcoin with all the headlines going on?
No, it's amazing. If you look at the 5-day chart, for example, we got a big bump after that decision came out in favor of Grayscale over the SEC. Completely given that back. We're below 30,000.
Excuse me, we're 26,065. You can't do Bitcoin round into 5,000. It's not like a Bitcoin bear.
Well, it's just that 30,000 was seen as this key level. And the theme was we got above that. We're going to stay above that. That was not the case.
What are the ramifications here if Bitcoin breaks down through the recent support?
I would love to know. Do we start to see whales start selling? Probably not. But when you think about the flush out that we saw of retail after we came off those record highs, if we get back below some of the recent exciting round numbers, then we could see another bit of a flush out.
For the first time in history, Bloomberg Surveillance at 8/11/55 Jobs Day, a crypto discussion. Let's save ourselves. The Standard & Poor's 500 up 0.4%. It is Jobs Day. We're going to go beneath the headline data. As I said earlier, non-farm payrolls, the establishment survey is, McKee will be along to translate. He does it better than anyone, literally, in the world, without exaggeration. But I'll be looking at the wage dynamic. I got a 4.4% year-over-year wage gain as a statistic. That doesn't include ECI benefits in that. But if I got a wage gain there and I got inflation supposedly below it, I think a lot of our viewers and listeners say, yeah, right. But the answer is maybe we have a positive real wage in America.
And that's good news if you're a retailer, if you rely on consumer spending. And certainly we haven't seen consumer spending exactly crack here. So all eyes on that wage growth. And as we try to figure out, again, what's consistent with that inflation target that the Fed is sticking to.
We got ISM coming up at 10 a.m. as well. Ferro's all over the ISM number. I don't know what that's about. But the answer is they're below 50. It's a diffusion index. And anything set below 50, maybe not German gloom, But the answer is it's pretty gloomy. 47 is one of the key statistics there. That's below 50.
Yeah, hearing diffusion makes me a little bit nervous, but the North Star of 50 is very helpful. I know below 50.
You can even tweak it from there. This is Haverford statistics that we're doing right now.
Yeah.
The central limit theorem at Haverford College. Okay. We got to bid the market, though, critically here, all kidding aside, with 15 minutes to go to that jobs report. The market believes in the American economy. The market believes in revenue and earning. Those levels, 45.33 SPX. We had a 35,000 print on Dow, 34,900. And I can't believe I'm saying that. Am I going to get a NASDAQ of 16,000 in the first days of September? Michael McKee at 8:30. It's Jobs Day.
The Fed, from the very beginning, had a misconception of that this was an ordinary inflation, excess demand, and responded wrongly. Our inflation has come down, but it has nothing to do with the Fed. It has basically because we resolved the supply side problem. We are lucky that Joe Biden got things right. The Fed got things wrong, but the two are going to balance out.
This is important, perfectly timed. Amy, thank you so much for putting the laureate, Joseph Stiglitz of Columbia University, there. And it's a really interesting time to segue here before the jobs report. And this is some of the insight that we hope to give you in Bloomberg Surveillance. That is Joseph Stiglitz. And I don't think most people know why he won the Nobel Prize. Someone who does. Katie Greifeld in for Bramo and Ferro, and Sassauer's work from home, or working from I don't know where Sassauer is.
Still counts.
Getting ready for college football season and all that. But this is really cool to talk to Randy Krosner, one of our great financial economists, of why Stiglitz is Stiglitz. There's Globalization and the Discontents, is a hugely successful book with Joe Stiglitz years out in front of a new globalization. Joining us now from Chicago, which is not Columbia, is Krosner, who is not Stiglitz. And yet, Randy Krosner, you know that Sandy Grossman and Joe Stiglitz wrote a paper that you and I have read 6 times. Folks, it's a Nobel laureate paper. It's maybe 6 pages long, and it's got the smallest, simplest equations about, as Ehlerian says, the unknown unknown. Randy Krosner, why did Joe Stiglitz win the Nobel Prize? What did he say about the information available?
Yeah, it's one of the key things in thinking about how markets work. And as you said, with another Chicago economist, Sandy Grossman, they thought really deeply about how information is reflected in market prices. And it's really those kinds of insights about how markets gather information from different people, not in the traditional voting booth, but through people buying and selling securities and buying, selling assets, that information is then reflected in the market prices.
Does Grossman Stiglitz, or even the social economics of Gary Becker, does it work in a fragmented America in 2023?
I think it still largely does. I think we see when people have different views of where Tesla is going or where the economy is going, that's then reflected in the prices. Now, they didn't say that everyone gets it right all the time. It's reflecting the information that people have, and people have incomplete information. Boy, and we are in a situation where the Fed and others have certainly have incomplete information.
Well, we're going to get a lot more information in just about 11 minutes or so. And I'm curious, when we think about this jobs report, put it into context for us. Of course, the size and scope here is that it's the final one before we get that September meeting, one of the final ones of 2023. What piece of the puzzle is this in trying to figure out what kind of landing we're heading towards?
So I think this is very important from the Fed's perspective as well as from the overall economy perspective. We've been seeing a softening of the job market over the last few months. Still a very strong job market. The unemployment rate is at roughly 50-year record lows. but we've been undershooting where markets have been expecting we would be, whereas we had been overshooting for almost basically since the beginning of 2021. So bit of a slowdown there. One of the key things, I think, is thinking about wages, because that's where the Fed is looking at. When it thinks about where's inflation going, it's kind of looking at one of the key inputs, one of the key cost factors, which is wages and overall employment costs. Because even in manufacturing, employment costs are a very high fraction of total costs. And in services, which is the vast majority of the U.S. economy, it's almost all about wages and compensation. And so we really need to think very carefully about that. And I think the Fed's going to be really focused on that piece.
I'm glad you brought that up, because we've been talking about it all morning. The fact after adjusting for inflation, U.S. workers are actually earning something. They're seeing their wages increase here. And when you factor that into inflation, extrapolate that out, how much of a further fuel is that for inflation pressures in this economy?
So it's great that workers are finally getting a real wage boost. That is that their wages are growing faster than inflation. But that's also a bit of a challenge for the Fed, because they want to bring inflation down. And if one of the biggest cost factors is now growing faster than overall inflation, that's a bit of a challenge. Also, I think that will affect the demand for labor, because when real wages have been negative, or when real wage growth has been negative, firms really want to hire people because they're relatively cheap. Now they've become relatively expensive, and I think that's also going to be a factor that will be weighing on the job market going forward.
Randy Krosner with Joe Stiglitz talking to Francine Lacroix in Italy. We can go back to the oddity of Gary, Indiana, giving us Joe Stiglitz and Paul Samuelson. Amazing, 23 miles from your University of Chicago. Mm-hmm. The poverty is painful. It is heartbreaking in Gary, Indiana. What is your policy prescription to help the poorest of poor people in America on this Jobs Day? Or if we move beyond that, where there's no help, it is a welfare state?
Oh, no. I think there's certainly lots of things that can be done. And so I think, one, making sure that we have strong labor market and strong overall economic growth is super important. Also, inflation tends to hit people at the lower end of the spectrum much harder than people at the higher end of the spectrum. People at the lower end of the spectrum tend to hold more of their total wealth in cash or deposits. And most people have been earning almost nothing on that as inflation has been going up a lot. And so trying to bring inflation down is also going to be something that'll help these guys.
Randy Krosner, John from Monza, that would be Ferro on vacation. He's over at Formula One in Italy. Randy, John says, get back to the chat of the Federal Reserve. Can this jobs report today actually shift a Federal Reserve as they go to the September meeting? I don't buy it.
Unlikely, but if it's an extreme report, for sure, it could. So if we see a real blowout jobs number, we see the wage number going up very dramatically, that's going to increase the likelihood that the Fed will act in September. If we see a report that's sort of in the range of what we're expecting, the wage growth continuing to be 4% or so, we see job growth in the 150 to 200,000 range, then they're more likely to pause and see where things go.
And I'm looking through your notes from August 4th, about a month ago. You write that the Fed got a gift. The inflation rate is coming down and the unemployment rate is not going up significantly. They would like to preserve this, no question. Is that sustainable?
Well, this is the great question about whether we can have the immaculate disinflation. That is, we can bring inflation down without the unemployment rate going up substantially. It's never happened before, and I never say never about anything, having lived through the global financial crisis at the Fed. But I do think that it's going to be difficult to bring the inflation rate down in a sustainable way without the unemployment rate at least moving up somewhat from where we are here, because there's still a lot of wage pressure that's there. And as we were talking about before, if one of the major cost factors for both services and manufacturing is going up at 4%, it's going to be very difficult to make sure that overall prices only go up at around 2%.
Professor Krosner will stay with us, folks, as we are 5 minutes away from this jobs report, as he always does. Jeffrey Rosenberg scheduled to be with us as well. Let's do a data check here. The dynamic, there's a pulse to the market. You see it with the red and green blinking on the Bloomberg screen, but I don't want to oversell it. Futures with that 4-day lift up 16. Dow futures up 121. The VIX 13.47 really says it all. Katie, even the real yield, as you go to it this afternoon with your show, the real yield gives way back to a 1.85. It's been a lower real yield the last number of days.
Absolutely, and you can see that expressed in the nominal. I mean, the fact that we were eyeing 440 earlier in August feels like a far way away right now.
Some people talking about an 8% mortgage rate. We're not there, but the bank rate, 30-year mortgage, affects the housing economy of America. Again, 4 minutes away here from the jobs report, always a mystery with the leadership of Michael McKee. We'll go beneath the headline data. On radio, on television, across America, this is Bloomberg Surveillance. Jobs Day in America. John Ferro, Lisa Abramowicz, well-earned vacations. Lisa's north of Tupper Lake. Ferro, almost to Monza there for the qualies tomorrow at Formula One. Katie Greifeld in for Lisa Abramowicz and John Ferro with our usual lineup of brilliance to give you perspective on the American labor economy. The lift here is futures up 17, the VIX 13.48. It is morning in America. It's always Jobs Day morning for Michael McKee, who gives us wisdom right now.
Well, the received wisdom here is things are a little bit better than expected. 187,000 jobs created during the month of August. That is exactly the same as the prior month. I'm waiting for the revisions to drop here because I don't think, here we go, 187,000. Wow. The unemployment rate, though, rises to 3.8%. Check that box for the Federal Reserve, I guess. We'll check on the non-farm payrolls revision in just a second. The change in manufacturing payrolls is big, 16,000. That was presaged in the ADP report, but it's kind of odd given the stories we've seen about manufacturing these days. Average hourly earnings come in much lower than anticipated, 0.2 increase after 0.4 last month, and on a year-over-year basis, that pushes us down to 4.3%. Now, that was what was expected. Labor force participation rate rises 62.8, which is kind of interesting. So a lot of underlying details here I'm going to want to check. The July number for the total payrolls is 157,000 after revisions, significantly lower, which means that we had a rise to the same level that we had last month. But that means probably a revision to August will be coming. Change in private payrolls, 155,000. That was initially reported as 172,000. It's 179,000 today. So 2 months, the revision, 110,000. Thank you to Bob in Connecticut for pointing that out to me. And it looks like this is the kind of report that will keep the Fed sidelined in
November. Come on, Mike.
September.
November?
I'm not going to go there. I'm not going to go to November yet because anything can happen. And I want to look into the details because there's a lot of threads to pull on this report.
Now, you go deeper into those two reports here with Randall Krosner coming up in moments. Right now on the market check, it is Fed-friendly towards a pause. I was busting Mike's chops about November. You know what? The market says pause in November. Futures advance up 26 on the Standard & Poor's 500 futures. Dow futures launch 152. The VIX comes in nicely. That's a key signal. The VIX 13.28. Could you imagine a 12 VIX to set up your Labor Day weekend? In the bond market, Katie Greifeld, help me here. In 5 solid basis points, 4.06 there. And the real yield, moving to your show this afternoon, a 182 real yield speaks volumes.
We just got a lot to talk about at 1 p.m. Eastern, but let's look at the 2-year yield right now, plunging down 10 basis points at one point. That seems to be, if you look across markets, where the most dramatic move is.
We're going to keep those shots up. For those of you on radio, it is a real adjustment off this jobs report. You see it with weaker dollar as well, suggesting a lower rate regime across America. You see it with yen coming in solidly, 144.88. To Mike McKee, for a couple observations. Can you say this is strike-induced? Are the actors and the screenwriters and vet bills off on strike, SAG and that? Can you plug in an LA entertainment strike to give us these gloomy numbers?
I give you a bigger one, and that is the Yellow Trucking Company going out of business. According to the Bureau of Labor Statistics, that cost about 30,000 jobs during the month, and that if you add those back in, then you would have a much more significant jobs gain than what we've seen. The other thing that stands out is that we have had a decline in state and local education, a significant decline in that, which is a seasonal adjustment issue because, of course, August is when everybody goes back to school and the teachers should be on the job. So it's pushing down that number and maybe artificially low.
Before we get to Professor Krosner, Michael McKee, you mentioned this as you always do, the wage dynamic. And you've told me, he schooled me, folks, year over year is for old fossils like me. Month over month is where the cool people like Mike McKee are. The month over month hourly earnings number from a 0.4 to 0.2, that's substantial, isn't it?
It is, and it does suggest that wage gains are slowing down. Now, interesting that the people in the trucking industry and the people in manufacturing who might be on strike coming up, those are higher paid jobs, so they would influence the overall number. We did see a big increase, as we have almost every month, in leisure and hospitality, about 40,000 jobs added there. Construction is kind of interesting because 22,000 additional jobs at a time when people say we can't find construction workers, and when home builders are putting homes in the ground as fast as you can do. The truckers actually lost 37,000 jobs, not just 30,000 jobs. So that was a significant headwind for these numbers.
Before we get to Krosner, Mike, I got to slip in one more question as you dive towards the 9 o'clock hour. We'll have a lot more perspective here. AMC says Miss Swift, her concert film breaks advanced sales records. You've been doing this for years. Can you tell me two entertainers, Taylor Swift and Beyonce, can move the needle on American GDP?
No, I'm not going to. I'm an outlier on that. The amount of money that they have generated is substantial, but it is a drop in the bucket compared to a $24 trillion economy. A couple of economists said that the Taylor Swift tour would add to August employment. I don't know how they would be thinking that. The tour began on March 27th and ended on August 9th. So you would think any Taylor Swift employment would have been accounted for.
And you've seen how many? You've seen 3 shows?
Yeah, and I'm actually getting ready to go to Europe and follow her around.
Yeah, I saw a $700 ticket in Lyon. You look in Paris, and $900 for her.
I might go to the movie just to see what everybody's talking about.
McKee's going to dive into this data, folks. It is a lift to the market. Standard & Poor's 500 futures up 0.6%, as well as a nice NASDAQ lift as well. Randall Krosner with perspective here, and we've got to forget about the economic mumbo-jumbo and go to the Fed. Professor Krosner, can you glean here a Fed that will change its attitude towards the November meeting?
So I think, as we were talking about before, this is kind of roughly what the Fed was expecting. You've seen a little bit less wage pressure, which is good from the Fed's perspective. We've seen greater labor force participation, which the Fed also likes. That's likely what is accounting for the increase in the unemployment rate. So you're seeing the kind of Goldilocks scenario that the Fed wants, that the labor market is gradually softening, but not cratering. It's taking some of the pressure off, and so that'll take the pressure off the Fed from raising rates. I think it'd be really unlikely that they're going to move in at the next meeting. And obviously, there's going to be a lot more data that'll come out between now and then. But unless there's some major surprise, they're probably likely going to hold through the rest of the year.
Randy, we've got to run, but one more quick question, if I may. It's a dual mandate. Is it really a dual mandate for this Federal Reserve System?
Well, this is the big pivot that came last year at Jackson Hole when Jay Powell said, there's one thing that we're going to do, and he said it 8 times, that we're going to fight inflation. So he basically said, sure, we have a dual mandate, but the inflation part is the most important. This year was kind of more back to normal, that we have to worry about both the inflation part as well as the employment part. And so that's why the Fed's looking so carefully at the data to make sure that they don't raise rates so much that they bring the unemployment rate zooming up.
Right.
It's hard to get that perfect. A lot of people think, the Fed can perfectly engineer this soft landing, that they have so much control that they can move the unemployment rate up just 1 or 2 tenths of a percent and leave it there. It's not so easy as that. There are a lot of other factors that come in.
Governor Krasner, thank you so much for joining us today. Professor Krasner at the Booth School in Chicago. Katie, why don't you bring in Jeffrey Rosenberg here? It's a bond market shifting.
Well, let's do it. Jeff Rosenberg, he is portfolio manager of the Systematic Multi-Strategy Fund over at BlackRock. Jeff, it's great to talk to you. You look at the first blush reaction in the markets. You have short end yields absolutely plunging. You have futures getting a bit of a bid. When you go through these numbers, is that the correct reaction?
I think it is. And I think this was the report that the market was looking for. You might have had a bigger reaction if it was a stronger than expected report, but this is the reaction of pricing out the last hike that the Fed suggested they might have to deliver. And so I think that market reaction makes a lot of sense. The front end of the curve, both in reals and nominals, is where you're seeing the biggest reaction, and that prices in the near-term expectations for Fed policy. So the labor markets are normalizing, and that's the main message from today's payroll report. Wages are softening a little bit on the margin, not really much movement in the 3-month averages. The 0.2, it just missed rounding up to 0.3. It's a 0.24. So you're seeing still the slowness in the last piece of the puzzle here, which is the slowdown in the wages. And so the Fed's going to still talk about that. But when you look at labor force participation, that's a big change. That's what the Fed wants to see. As Randy said, that's the reason for the increase in the unemployment rate. But as we saw earlier in the JOLTS data, this is exactly what the Fed is looking for in terms of getting the normalization in the labor market, seeing that reduction in the vacancies to unemployment coming through the vacancies, less from the pain in the unemployment. And that's a good outlook for the market. And that's why you see the equity and the risky side also positively responding here. So pretty much a very nice number for everyone to go into their last holiday weekend. Yes.
And Jeff, you talk about the labor market normalizing here. Extrapolate this into Fed policy, because at a certain point, the Fed is going to have to cut interest rates just to bring rates back to more normal, neutral levels. Does this report push those rates further into the future, or does it bring them forward?
Well, it's a really important point, which you just highlighted, about the need to be cutting interest rates, not necessarily to bring them to more normal levels, but go back to Powell's speech last week. It's about restrictive policy for longer, not higher for longer. And so as inflation falls, and that's really about the wage inflation picture from today's report, the Fed has to cut rates to avoid the real interest rate from increasing. And that's really what the bond market has priced in for next year. The gradual decline in inflation leading the Fed to have to cut rates, not because it's a hard landing or because they're cutting rates because they're overly tight, but they're cutting rates to avoid becoming overly tight, to maintain restrictiveness. And I think today's report just feeds into that market consensus and that market expectation.
Hey, Jeff, I find this absolutely extraordinary, which is we had a failure of transitory, and then dare I say, and granted, there's an ambiguity here, folks, if we actually get price up, yield down, but we're almost back to a successful victory lap for the Fed. Do you agree that this is a Fed on the edge of a victory lap?
Well, I think one thing we have to be a bit careful about, Tom, is that we've certainly seen the victory from these very aggressive, very historically distorted levels of inflation due to the COVID supply side shock.
Yeah.
That's very different than claiming victory, that the damage that had occurred as a result of those policies, as a result of the fiscal and monetary policy overstimulus, has completely been wrung out. And so that's about the victory from 3% to 2%. You remember from last week, Powell, one of the main takeaways, two main takeaways were data dependence, yes. But the other big one was we are not abandoning, the Fed said, Powell said, we are not abandoning the 2% inflation target.
Right.
A lot of discussion around, hey, just accept 3%, it'll be okay. So I think before you can claim victory and do the victory lap, we really are going to be talking about what does it take to get you from 3 to 2? What's the cost versus the benefit of just leaving it at a higher rate.
And now pre-Labor Day, Carnegie Mellon Math. We're going to do this with Jeffrey Rosenberg. Come on, Jason Furman's out doing this correctly, Jeff, talking about the ecumenical PCE index. And you know, Jeff Rosenberg, it's how you pick your duration of the vector. Are you looking at a 1-year annualized or a 6-month annualized, or what I do, which is a 90-day annualized, 3-month annualized vector for inflation? What is the rapidity of the decline in inflation right now?
So on the headline and even on the core, you're seeing, good progress. And to the part of the question, it's much more relevant to look at kind of the near-term numbers, annualizing what is that pace of decline. But it's really about this core measure that Powell talks about in terms of services, less housing, that really gets to, again, the wage inflation picture that feeds into the more durable aspects of inflation outside of the commodity and goods sector, which is deflating because of the supply side improvement. What has been very supportive over the last 3 months is that 3-month level of core inflation has been declining. And so it's feeding into this soft landing on inflation narrative. It's still a slow pace, and I think that's what you see in today's wage number, but it is going in the right direction. You brought up the equity market. That's positive for the equity market. So everything is looking like it's moving in the right directions. It's still a bit slow, but certainly the labor market normalization story got a boost from today's report.
I want to bring this conversation more firmly to the markets. Ian Lingen was on surveillance a couple of days ago of BMO, calling the 10-year Treasury a screaming buy. I think that made multiple headlines. When you look at this report and the totality of data that we've gotten in the past couple of months, do you think now is the time to really step forcefully into duration?
Well, when we talk about duration, it's not so much how much duration you hold, but where in terms of the maturity spectrum you hold that duration. So I think that the screaming buy is the 2-year. Thank you for bringing it up, because I think there you have the best combination of yield and the exposure, as we're seeing in today's market reaction to changes in this kind of normalization. That is the part of the yield curve where I think you're going to have the best risk reward in terms of owning duration. When you start talking about the long end, now you got to start considering whether or not the term premium, the long-term inflation premium, whether the long-term real interest rate is really priced appropriately. And I think there's a lot of questions about whether this post-COVID, post-normalization yield curve at historic levels of inversion is really where you want to be concentrating your duration in the long end exposure. I think there's much more vulnerability in the long end, given that degree of inversion, which basically says you're not getting paid in terms of the yield for those fundamental factors, which all could be increasing in this post-COVID environment.
Jeff, thank you. Jeff Rosenberg is with BlackRock there. Great perspective with the bond market on the move, a solid 7 basis point move. That's a big move for those keeping score at home on the 2-year yield, 4.79%. Futures up 0.6%, up 26 points. NASDAQ giving me the same 0.6%. Look, and the VIX on a tear, 13.29. Got a number of ways to go here, but what I know is he's piling into pages of data from labor, from BEA, from census, and the other 7 organizations on Jobs Day. What's a singular McKee insight right now?
We also checked your grocery list, Tom. 736,000 people entered the labor force during the month of August, a huge figure. And that's why we saw the unemployment rate go up, because 222,000 of them got jobs, but 514,000 didn't. Now, this is good news in a way for the Fed. They've been expecting the unemployment rate to rise, and it did. And they also expected the labor market to loosen. And obviously, it has loosened in the month of August. So it tells them some good news. The other thing to look at here is that we did see a rise in unemployment for whites to 3.4% from 3.1%, but black unemployment went down to 5.3% from 5.8%. That had reversed a couple of months ago and gone way up. So that is better news as well, because there's always the fear that,
Right.
last hired, first fired, et cetera.
We got to go quickly here, but is there a big difference between 3.9% unemployment and 4.0% unemployment?
Not
psychologically, is there a big difference?
I don't know whether American people would think that. As long as they have jobs, they're probably less concerned with the headline number. But it is the Fed that's looking at it. And remember, they forecast 4.1 by the end of the year, and everybody thought they were going to have to change that because it was going to be too high. Now maybe it's within reach.
We dash to Ira Jersey now, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence here on bonds. Ira, are mortgage rates going to come down off all this good news?
Very little bit here. The long end is already priced for the Federal Reserve at some point to cut interest rates, a modest amount. It's really, I'm focused more on that front end and how the market is interpreting this data in terms of not only a November hike and the probabilities of that, but more importantly, the Fed being on hold for even longer than maybe people thought. So we're still in this environment where the market is going to remain inverted for a long time, but this data has to be pleasing to the Fed, and I think means that you can have 2-year yields that will remain below 5% at least for a little while.
Feels like we're well below 5% at this point. Your 2-year Treasury yield below 4.80. And Ira, on your point on the curve that we're going to remain inverted for a long time, where is that pressure going to come from? What end of the curve basically is going to be driving that dynamic?
Well, I think the long end of the curve, the 10-year, the 30-year, will probably hover basically where it is now, say a little bit, 4%, 4.10, 3.80, something like that. But it's really going to be that 2-year yield that's going to drive the shape of the curve going forward, just like it did when we got to negative 100 basis points on the 2-10s curve. That was because 2s were up above 5%. Now that we're down and likely to trend a little bit lower over time, you'll start to see an uninversion of the curve. But I think that process is going to be relatively slow, particularly because today's data is almost Goldilocks in a way, because you still have an environment where you're growing jobs, but in the inflation components of this data is slowing. When you look at the wage data, for example, then that just means that the Fed can remain on hold, just like Jay Powell's been talking about, well into 2024, if not to late 2024, assuming we don't start to get negative job prints.
And Ira, I want to stay on levels here since we've seen some pretty amazing moves in the bond market over the past month. If 2-year yields are probably going to stay below 5% for some time here, you look at the benchmark 10-year Treasury yield, where is equilibrium right now?
Well, so that depends on what model you use for fair value. So we have some models that say we're pretty close to fair value now, but our fundamental model suggests that we should actually be a bit lower in yield, closer to 3.6, 3.7%. So I think that the risk here is that we can rally a little bit, particularly if we have some softness and things like the equity market, where I think the path of least resistance is going to be toward somewhat lower yields as opposed to higher.
Ira, if the 10-year real yield breaks down, what is the ramification of that? There's a technical level. Ian Lingland brought this up yesterday. But if you get, with a 10-year real yield, 1.85%, I don't know where the breakdown is on support. But what happens? What's the so what if the real yield walks away from 2%?
Well, I think some of that's the fear of missing out, right? Because if we are truly in a different inflation regime than we've been in the last couple of decades, then people should like real yields, right? Like being able to buy tips and being able to get some inflation compensation on top of this, a positive real yield. Remember, we spent a very long time with real yields being negative and quite substantially negative for a very long time. So tips in some ways I think are pretty attractive at these kind of levels. And keep in mind, like when we talk about the rate moves that we've seen over the last month, it hasn't been inflation expectations that's been moving. It's been real yields. And the way that we look at real yields, there's basically two major things that affect them. One is liquidity and volatility of the Treasury market. Obviously, we've had a lot of that. But importantly, it's also expectations for policy rates. And if policy rate is that the policy rate's going to be going down at some point in the future, then you'd expect real yields also to follow that. Will we get to zero or negative? I don't think so this cycle, but we could certainly rally from 185 on 10-year real yields down to 1%.
Wow. Ira Jersey, thank you so much with Bloomberg Intelligence. Because of time, with futures up 25 right now on SPX, we get to the equity markets off of this shocking jobs report. Sarah Hunt joins us, Chief Market Strategist, Alpine Saxon Woods. Sarah, it's real simple. I've got an 11.8% Standard & Poor's 500 return over the last decade. I got a lineup of people with fear. How do you push away the fear into September, into the fourth quarter, given this economic data and a successful Fed soft landing?
Well, good morning, Tom, and thank you for having me. I think this is really an interesting report, especially since we revised last month negative. And I think that this is, I feel like Ira Jersey stole my Goldilocks moment. I was going to say that's a Goldilocks number because you've got all the components working in the direction that the Fed wanted to go. Remember, we were looking for, on some of the summary of economic projections, 4.5% unemployment by the end of the year, and it's been staying so steady that number looked unachievable. 3.8 is not 4.5, but directionally, that's what the Fed was looking for. I also think that the softening in wage gains is also something that the Fed was looking for. The interesting thing is about the number of people who have come back into the labor force. And you have to wonder if some combination of the fact that pandemic surplus is being spent down, student loans are coming back, may be part of what is shifting the labor force. Because the question has been whether or not it's structural to have so many fewer workers, or it's possible that so many people didn't have to go look for a job, and all of a sudden they're staring down what is not as rosy an economic picture without as much of a savings backdrop.
And Sarah, like you said, this is good news for the Fed. That seems to be the narrative in markets right now. But how noisy is this data? You look at some of the specifics from the BLS. Film industry payrolls fell by 17,000. Then you take a look at trucking payrolls fell by 37,000. How much of a piece of the conversation will some of those nuances be?
Well, I think this also goes to one of your earlier guests this morning was talking about the fact that the economy is rolling in cycles and nothing is moving at the same time. Historically, in a recession, everything goes down and then everything comes back at once. And we've been through such an odd period of time during this pandemic where you've had rolling recessions in some sectors and not in others. And I think that those labor numbers just speak to that you've got different places where you're experiencing either a boom in labor or a slowdown. And I think that the labor hoarding that's gone on is probably slowing down as companies are getting a little bit harder. It's harder for them to push price a little bit in this environment. So I think that that's where you're going to start to see movement, where you pretty much have not seen a lot of movement year to date.
Sarah Hunt, in the market, in what is a bull market with a VIX of 13.29. Sarah Hunt is with Alpine Saxon Woods. Michael McKee is in the triple leveraged all cash fund. He and I have missed this great bull market. So we have to keep working.
We have to
on
keep
Labor
working.
Day.
And
No days off.
I've been looking at some more numbers, and I want to give you one more number in honor of the lady sitting between us. People with two jobs. Since she's also anchoring the afternoon shows, rose by 300 during the month. So you consider yourself special because
we're temporary workers right now.
Temporary workers. The number went down a little bit, I believe, but it is. It has not been a major impact on the numbers lately.
It's interesting. I mean, I'm absolutely fascinated now how we stagger to the inflation report. I can't remember when it is, September 12th, whatever
coming up.
The coming up. But the inflation report coming up, Michael, has to have an even greater weight after this is this Goldilocks report, as Ira Jersey and Sarah Hunt put it.
Well, it does. It would have to be bad for the Fed to probably go in September. Again, I'm not going to touch November because there's a lot of numbers between now and November, and everything could change.
I mean, I'm looking at futures up 23, Dow futures up 138. It's just going to be fascinating to see. And on the real yield, Katie Greifeld, I mean, we make jokes about it, but I'm sorry. That number Ira Jersey spoke of a real yield down to 1.3% is game-changing.
Game-changing.
And very different from Europe. I mean, polar extreme from the discussion in Europe right
And not just for the bond market either. You think about the read-through into some of these risk assets that we talk about all the time, into corporate credit. Where that real yield goes is very consequential.
Can you do something about the 30-year bank rate mortgage?
I think if I could, I would.
Can we call Labor Day weekend like the end of the idiocy in the housing market?
I don't know. It doesn't seem like buyers or sellers are having a great time right now.
Technically, it is brutal. I mean, above a 7.5% level. I mean, and some really interesting work going on right now. I really want to summarize this. I mentioned Professor Furman at Harvard University talking here about how you measure the inflation rate across a 1-year annualized, 6 months, 3 month, and that. But the other thing you need to talk about is just simply disinflation and where the outcome is in 2024. And there's a huge divide between Andrew Hollenhorst of Citigroup, say, and what we see from Edward Hyman at Evercore ISI.
Absolutely. And where this jobs report moves us on that narrative, maybe a win for the disinflation count.
Help me here with the mortgage market. The 2-year yield, as Jeff Rosenberg says, craters, 8 basis points lower yield. The 30-year bond is a proxy for that. Mortgage goes up.
Yeah.
The yield went up here on jobs day 30-year. No house hunting this weekend. Thank you to our team for a spirited Friday Labor Day report. Stay with us. This is Bloomberg.